Hello, everyone.
Hi there.
Hello, Hans.
Good to see you. How are you?
Good to see you. We're just getting everyone to pop on live at the moment. I'll just give it another minute as the participants start coming in.
Okay.
Brilliant. We'll see you in a little bit.
Yes, take care.
Right, great. Welcome, everyone. We're just giving it a half a minute so that everyone can join in. Okay, good. I see we've got our founders rolling in. It's my honor to say welcome to all of you guys. Welcome to Founders Conference 2020. We're very excited to be able to, in spite of this crazy year that we're in, we're still able to, bring 100 odd founders and investors together from all over the world. We've got participants from 4 continents today and speakers from 3 continents. So it promises to be a really exciting day, packed full of content. I know this is home stretch. There's only about 4 full weeks left of this calendar year. So I know that everyone is super busy. So because of that, we really appreciate you guys being here with us today. We've gone through a lot of trouble to make sure that we have an absolute world-class lineup of speakers for you guys to listen to today. So I'm really stoked in terms of what we can learn from the experience being shared today, how we can, and how we're bringing people together in a time such as this. So just a little bit about kind of founders events and founders conference and how it all came about. Basically, 2 years ago in 2018, we just saw that there wasn't a single event listed for Global Entrepreneurship Week in Cape Town. And we decided, well, this is crazy. That was maybe about 3 weeks ahead of Global Entrepreneurship Week. And we decided, no, something has to be done. We have to put an event together. And our marketing and events team just pulled together, and we managed to, within 3 weeks, get an event together with, I think, 80 people in person at the Woodstock Exchange, and it was at the waterfront. And we had such great founders sharing their stories and their journeys about their wins, their losses, their personal lives, their biggest lessons learned, and a whole bunch of other things. And I think we just felt like it's so cool to bring people together in that way, because at the end of the day, like we say in the video, the entrepreneurship journey can be a lonely one, right? It can be a difficult one. You can't necessarily share all of your biggest highs and biggest lows with everyone in your life. So it's really special to have a group of founders and entrepreneurs and investors who you can build relationships with, who you can walk the path with, and really kind of get the journey that you're on. So yeah, today is all about that. The entrepreneurs, going through the motions, building some of the best companies in the world. I know we've got some people here who are busy with amazing businesses. So we hope today can just serve as something to encourage you and inspire you, and maybe even teach you a couple of things that you didn't know from fields of expertise that that we've drawn from all over the world. We're super excited about kind of what lies ahead. I just want to quickly show you guys what the lineup looks like. Let's give it a second to load. There we go. I trust you can all kind of see the screen. We've got a kick-ass bunch of speakers today here who are going to take us through a lot of different, really exciting sessions. The day is going to span kind of starting now all the way through to about 4 o'clock South African time. So we've got Tanya van Lille first up. She's the head of the South African Venture Capital Association, and she's going to be talking about the VC and investment industry. Then we've got two of the biggest investors in the world, I think, that are going to be with us. You just saw Hans pop on with me a little bit earlier. He's one of the biggest European names in investments and venture capital, and Manuel Koza is probably one of the biggest names in Africa, even though he's German, in terms of the VC space. Richard Sharp is back on the stage, back from 2018. He had a great share there today. He's going to talk to us about investing in unicorn companies, and a really special journey that they've had today. We've got our corporate partners in Investec. They're going to be doing a talk about just how corporate is working with entrepreneurs from an entrepreneurial bank's perspective. And then we've got our head of advisory and our finance director, Jock and Uwais, are going to be chatting to us about kind of like what is the perfect finance function for a scale-up company. I'm going to take a quick break. Then we're going to talk about selling your company. Looking at exits, we've got one of the authorities on selling companies, Dustin Graham from Benchmark, and an entrepreneur who've sold to a listed corporate, Simon Hartley, who sold one drop. We're going to hear from their experience shares. Then we're going to talk about global structuring. We're going to talk about breaking through barriers, and we're going to talk about leadership and a whole bunch of really other interesting things. But we'll get to all of those kind of as the day goes by. But from my side, I just wanted to say, thank you for being here with us. Sit back, relax, and enjoy. Maybe if you can, try to put off your phone, put off your emails, and just try to use this as focus time. I think the more focused you can be in these sessions, the more you'll get out of each of them, because they're going to be content packed. They're short. They're 10 and 15-minute sessions for most of them. So they're going to be powerhouse. So maybe try and switch off all the distractions and be here with us. Then we're ready to basically kick things off. So then as a first port of call, a good friend of mine, Tanya, is here with us today. Tanya, are you online? Will you mind popping on your screen if you're able to?
Hello, how are you?
Hey, welcome, Tanya. It's so great to have you.
No, it's great to be here.
Good. So guys, we're very privileged to have Tanya speak with us today. She's the very, very busy CEO of the South African Venture Capital and Private Equity Association. So, she basically runs the industry from a South African and pretty much African perspective, if I may say so. So we're really keen to start this day with the state of the venture capital industry, in the country, on the continent, and in the world. Like, some of those views would be really, really cool to hear. But Tanya specifically going to chat to us about the African perspective, and I'd love to hear how 2020 has influenced all of that. So then, without further ado, from my side, I'm going to hand over to our first expert, Tanya. We're so stoked to have you, and good luck for the session.
Thank you, Lo, and thank you to your team as well for trusting me to be the first speaker this afternoon. It's actually a wonderful honor, so thank you for that. I've prepared a few slides, but I don't want to do death by PowerPoint, but I do think it's important to use a few slides just to bring the points across, especially because I'm going to speak a little bit about some of the data in Africa. In terms of the actual, what the numbers look like. So there isn't a concrete answer as to how big is the VC industry in Africa. There's various reports that are being published. SAFCA does an annual survey, mainly for South Africa early stage investors. But Africa also recently did a survey. They looked at 2014 to 2019 over a 5-year window, and estimated that about $400 million dollars were invested in early stage investments or by VCs. Then Partech also does an annual survey, a really good survey. But with their survey, they actually only look at technical or tech companies. So where AFCA and SAFCA may also look at other kinds of industries that are being invested in, Partech is purely tech investments. And for them, they recorded 66 investments in 2019, valued just over $200 million. So although we don't have a picture of exactly what the industry looks like, what we do have is a view on that the industry is growing. So VC in Africa is growing, and I think that is what everyone can agree on, regardless of who's doing the report. But how do we stack up if we look at the different countries, continent that are known for VC? And what we see is that 2018, South Africa still played a prominent role in venture capital penetration on the continent. Yet in 2019, Nigeria and Kenya leapfrogged South Africa in terms of VC investments and transactions. And there's a bigger portion of their GDP that are going into VC investments in those countries. So not only are we competing for capital amongst each other, we're also competing for capital across the continent with entrepreneurs across Africa, not only in South Africa. What I wanted to show you is the top 10 deals according to WeTracker for 2019. And as you can see, 5 out of the top 10 are fintech. So we're seeing a lot of fintech happening on the continent, some health tech, some logistics, etc. But we can see the size of the checks vary exponentially in terms of the check sizes that are being written, who's writing them. You can see there are some local VC fund managers in there, international VC fund managers, some corporates, and today you'll speak about the role that corporates play. But as you can see, it's a very competitive industry in terms of getting VC money. It just seems like there's a lot more deals chasing not enough VC money at the moment. Just to put it into perspective, a lot of times Africa VC and South African VC are criticized for not investing enough or not doing enough. But what I wanted to show you here on the left is this. This is from the PwC CB Insights report. And what they show is this is just 2018 Q1 deals. So we don't have the latest. But just in San Francisco, the North Bay area, just in Q1, $6.3 million were invested. And if you count that with Silicon Valley, which is number 3 in the South Bay area, just those two alone are almost bigger than what we see happening in a country on the African continent in a year. This is just to give you a little bit of a perspective. The VC industry in Africa is not VC in the US yet. We're far behind, we're still nascent, we're young, we're growing, but we're not there yet. The first VC transactions took place in the early 1970s when semiconductors were founded. And universities like Stanford played a huge role in developing the VC ecosystem in Silicon Valley. But in Africa, what we find is that there's not enough fund managers with big enough funds and a long-standing track record to invest in our entrepreneurship ecosystem. So what do we need? We need more VC fund managers with bigger fund sizes, and we need to give them time to build up a track record. In South Africa, our VC industry is nearly 15 years old. So we still have a lot of work to do and a lot of catch up to do to the more developed markets where VC has been a staple for more than 30 years. In terms of what we see from a funding gap perspective, there are definitely funding gaps in the value chain, specifically in the seed early stage funding. When someone or an entrepreneur comes up with an idea, there's not a lot of money available for that. Then there's some angel funding money available, and then your VC fund managers start to invest. Traditionally, the VC fund managers that were born and bred on the continent will invest in what we call a round or Series A, Series B, the first and second round of funding. But we do not have enough fund managers to co-invest or to invest in multiple rounds. So you'll see as an entrepreneur, as you start growing, you might find it more and more difficult to get local VCs that can invest when you are in Series C, D, etc. And that's where a lot of entrepreneurs then go overseas and try to find capital. There's also a lack of institutional investors that invest in VC funds. Just like an entrepreneur needs to go and fundraise, the same thing happens with a VC fund manager. They also need to fundraise. They also need to get others to believe in their fund strategy and their mandate, to give them their money, trust them with their money for investment, and that ultimately will get some form of returns. So what we're seeing in terms of who's investing in the VC industry, it's mainly high net worth individuals, family offices, other entrepreneurs that have made a success that reinvest in the funds that have invested in them. Some entrepreneurs have started their own funds, but we hardly see any institutional money investing into local VC fund managers. In South Africa, for example, the biggest or only institutional investors that are investing in VC fund managers is the SA SME Fund. They've sort of laid the foundation for others to follow, but we lack institutional investors on the continent. A fragmented ecosystem, so many people are doing so many things. We've got incubators, accelerators, we've got VC fund managers, angel networks, we've got grant funding from governments, that there's so many pieces of the puzzle and everyone is trying to do the same thing, but we sometimes speak over each other. And there's opportunities for efficiencies and actually working together and more partnership. And then regulatory policy and restrictions. Each country has different regulatory policies or restrictions or opportunities for founders and entrepreneurs, and it differs from country to country. What I quickly just want to talk to you about is the regulatory hurdles. What we can see here is a timeline that I4 Policy has done for us when they did some research done for the African continent. And in terms of small business acts and startup acts, Ghana was at the forefront of establishing a small business act in the 1980s. The US's Small Business Act was in 1957, so they're even ahead of the curve in that regard. South Africa's Small Business Act came in 1995, same with Zambia, and a few other African countries followed. In terms of a startup act, Tunisia was the first one on the continent to do so, followed by Senegal and Mali. And there's 3 or 4 others that are currently working on startup acts or establishing startup acts. And the kinds of things that they address in startup acts based on the research from I4 Policy are these 7 areas of policy reform with 36 sub-challenges that they've identified. So they believe if countries address these 7 areas in their policies and startup acts, it will be a more conducive environment for entrepreneurship to thrive in. Just out of interest, SAFCA and a consortium of various players are working together to actually do this for South Africa, form an SA Startup Act. So what are the trends? What trends are we seeing? We're seeing VCs growing, although we can't agree on the numbers, and some deals are disclosed and others aren't. But local VCs are growing, as well as international VC interest on the continent. By those top 10 transactions we saw from 2019, you can see that there's a lot of international interest into African entrepreneurs. We're seeing more development finance institutions taking an interest in VC. We've seen FMO, IFC, Proparco, a few have indicated their interest to invest in the VC ecosystems on the African continent. However, it must link to their mandate. So if it doesn't link to their mandate, they won't necessarily invest. So their mandate might be financial inclusion, it might be a gender lens perspective. So depending on their mandate is whether they invest or not. And they tend to invest in fund managers that have a pan-African investment strategy. So they won't hardly invest in VCs that have a one country focus. We're also seeing more corporate VC, and you're going to talk about this a little bit later in the panel. We're seeing a lot more interest in corporates investing in VC, either as part of, as a substitute to their R&D budgets, looking at investing in entrepreneurs that are coming up with great innovations that they can tie into their business operations and products and services, or it's a corporate VC arm that have been established with similar to what you would find as an independent VC fund manager. And then here is a pic of one of our board members and someone that frequently writes and comments in the VC sector in South Africa, Keert van Zyl. For him, he says, rather than chasing the unicorn, we must nurture the gazelles. So the gazelles are those companies that show 20% plus return year on year. And he says for VCs and for African entrepreneurs to succeed, rather than chasing that one unicorn that may or may not happen, let's rather support a lot of gazelles that can create growth and economic opportunities and jobs within the countries that we invest in. Lo, that's it from my side. That was my quick 15 minutes. I hope I've shared something that that the audience can use and some food for thought as you go into the rest of the session.
That's perfect. Tonya, thank you so much for being here with us today. Really, really appreciate it. It's always exciting to see how the ecosystem is evolving here on the continent. And thank you for the great work you guys are doing at SAFCA to help push that agenda. We're really excited about the next couple of years over here.
Thank you, Lo. It's my pleasure, and good luck for the rest of the day.
Thanks so much. All the best. Okay. All right, guys. So first power session done. We are very stoked to hear Mr. Hans Otterling and Manuel Kozer being interviewed by Atos CFO's very own Leanne. These are two of the biggest investors I believe that are out there. So we're very keen to hear some of the thoughts, and I'm going to leave it over to my capable manager to grill them with some of the most interesting questions you can think of.
All right. Can you guys see me?
For some reason, I can't start my video.
Okay.
Because the host stopped it. So
Michael. we have to keep an eye on you, Hans.
The host must start the video. All right. While we're waiting for them
There we go.
to.
Good to
Oh,
see
yeah.
you guys.
Good to see you, Hans. All right, great. Let's kick it off. Thank you, gentlemen, for joining us this afternoon, where we'll be talking about fundraising for growth. So, yeah, it is my great privilege to do so. I was following on from what Tanya was talking about, how the ecosystem has grown, but how it's still very young in South Africa, the VC ecosystem. So I'll start with you, Manuel, will you please introduce yourself to the audience? Tell us a little bit more about who you are and what you do as a venture capitalist.
Yeah, thanks for having me, and always great to see people coming together, especially in these kind of difficult times, to try to do something entrepreneurial. I'm German originally, moved to beautiful Cape Town to start an online fashion business. Did that for 2 or 3 years with mixed enjoyment, mixed success, and then said, cool, let's try to move to the capital side. That sounds way more interesting and easier, which it doesn't turn out to be. We invest off balance sheet, mostly our own capital, very operationally involved in consumer brands and consumer internet companies, a very kind of focused approach for the South African ecosystem, not a traditional venture fund, and kind of we're morphing more and more into kind of strategic player. And I think kind of for me always in that the headline as it's called, raising for growth, is firstly actually unpacking why you need to raise money to begin with. Because I feel very often, and I have this from my own experience, it's almost this kind of socially driven KPI. You need to raise a lot of money, and it isn't always the right answer, especially in very young ecosystems. So I think I just urge everyone to really, really unpack why you need money to begin with, and what it's for, and why you need a partner in your business, because it complicates a lot of things. It sets you on a certain path. And in lots of conversation I have in private capacity or in Silvertree, I get the sense it's just the thing you're supposed to do, and it's your kind of key KPI that the next TechCrunch Venture Burn article can say, I've raised a lot of money, which actually only sets you up for playing. It doesn't really, it's not a success. It just allows you to play.
Oh, interesting. Hans, what's your take on that? How do you see the venture capital markets in South Africa at the moment, the whole landscape? And what is your hand in it? What are you busy with at the moment?
So I had the opportunity and the privilege to spend, last year in Cape Town, meeting Emmanuel and really learning about how venture capital is developing in Africa overall, and also in South Africa. And I am very bullish. I must say that I think the next 10 years is it's going to change dramatically in Africa. And there's a couple of reasons for that. The international players are opportunistically investing currently, right? So they hear about something and they do one-off deal. But I think pretty soon we will see funds that actually have an African mandate to invest in Africa. And why is this happening? Well, the fact is, there's 1.3 billion people living on the African continent. You are definitely the youngest continent of every, I think it's like 60% of the population is below 25 years old, which means, the digital adoption is going to go so much faster in Africa than anywhere else. Africa is the most, I think the fintech is the biggest spread. Mobile fintech is by far most highly used in Africa. And you're going to leapfrog sectors like healthcare. You're not going to build big hospitals and all that infrastructure. You're going to log on and you're going to meet your doctor online. The same thing with edtech, with education. Africa is not going to build, the old school system. You can log on to the best teacher in the world and on your iPad. So So there's a lot of things that are playing into Africa's favor, right? When it comes to demographics, growing up, etc. So I'm quite bullish on Africa on a macro level. And then I agree with Manuel. You know, if you go down to your own company and say, first question is, why do I raise capital? I think that's a first question you should ask yourself. You know, it's, you know, we tell entrepreneurs when they close the deal with us, let's say they raise $10 million, don't open a bottle of champagne. It's not a celebration moment. That's when the work starts, right? Celebrate when you do a great deal for a customer, or when you celebrate that you reach a new revenue number or whatever. But you just raise money. That's not something to celebrate per se. So having said that, I'm not going to take more time now. I'm going to let Manuel speak a little bit. So I'm coming later.
All right, thank you. I think the big question in my mind, or in everyone's mind who's here, is what are you looking for in an investment as a venture capitalist? I'll let Manuel go for that. What are you looking for in an investment?
Look, I think ultimately what you want as the first priority is a passionate, very driven entrepreneur. Because this journey you're embarking on is going to hit you in the face like every day. And you want this person to be the driving force to stand up when everyone else wants to just lie down on the floor and give up. Because this journey is tough. If you have tailwind, it's tough. If you have headwind, it's tough. And it really, really makes the difference to build kind of this high performance culture and kind of live it with passion and drive. And then look, there's some, I think most of the other topics come from talent, but obviously you want to be in a market that is growing. You want a differentiated product that solves a customer problem unreasonably well, 10 times better than the next best alternative. Then look, you can look from a financial perspective. You want to see good growth. You want to see good margin. You want to see good capital efficiency. You kind of want to understand what the competition is like and where they're moving. So that's kind of there's probably like 20 other variables you can look at, but I think those are the kind of most important ones. And then from an investor perspective, I think it's quite important to be able to change hats quite quickly, right? So the other piece is, look, this is a financial transaction, right? So you will look at a risk-adjusted return that you need to make. And a traditional VC investor, which kind of we don't really fall into, it's quite important to understand the fund economics, right? So out of a fund, 5 of your investment, you will write off, they'll die, if you're early stage venture. 2 or 3 will kind of make 2-3 times their money. And then you need this 1 or 1.5 companies to shoot out the lights. So over the whole fund, you can have a return of at least 3-4 times your money, IRR 30-40% in US dollars and more. So that sets the hurdle quite high, right? That also sets the hurdle quite high to Hans' point. Once you've raised the money, now the hurdle just got raised by 2-3x. And you need to, because almost as you've taken on debt, and kind of vision of these guys around it. And look, there are a couple of, like, so the macro story Hans just told you, which I believe is very accurate. There are a couple of incredible sectors that have tailwind now. There was very successful exits in the fintech space recently that obviously investors ask themselves, cool, am I missing something? This Africa thing seems to work. There are people making money. These are good companies buying in. Stripe is celebrated. Network International is celebrated, buying two interesting assets. EdTech, an obvious one. Healthcare, an obvious one. E-com, kind of anything software as a services related. There are lots and lots of sectors. The question is, can you build a product that is differentiated and solve a customer problem very, very well in that space? And the other topics will follow in that space. And I think the attention will shift quite quickly.
Interesting. So I think quite interesting to note that there are a couple of things that you're looking for from your side. You did say that you guys are shifting from being a venture capitalist in the strict sense of the word. What do you look for, Hans? What makes a business fundable to you? What are the critical things you want to see in an entrepreneurial company before you even consider investing in it?
So if we try to simplify it as much as possible, I think there are three things. Number one, is there a product? So if there a product, is there a service that we think has, is functioning? So risk number one, product. Second risk, is this product actually someone wants to buy this product? Is there a product market fit, which you usually talk about? And are the customers like to buy the product again? Recurring revenue. Everyone wants to see recurring revenue. So you have product risk, you have commercial risk, and then you have execution risk. And that's the team, what Manuel just spoke about. So when you meet an investor, they're gonna focus on these three items, right? What is the product? What is the uniqueness? Is it actually a customer that I can call and ask them what they think about this product? And what do I think about the team's capability of executing the business plan, attracting new talent to the company, and also being able to raise a second and a third round, which is usually the case when you are in a growth company. So that those three things, if you have those in mind when you build your company from a high level, then you can meet an investor and run through a presentation with them on those three topics.
Sure. Serious nuggets for anyone who was taking notes from these two gentlemen. My next question, I'll stay with you, Hans. What industries or type of companies are hot right now? So if you were to pinpoint the industries, I mean, everyone's talking about tech, but I would suppose, what is the hottest things right now?
So, I mean, COVID-19 has thrown everything, in a kind of a turbo mode, right? So our portfolio companies, if you take almost any sector except travel and hotels, but any other sector is doing phenomenally well in tech. So, but what I would like to say to African entrepreneurs, is that, I've seen a lot of Me Too products. So you see something in the US and you import it to South Africa or to Kenya, and you do the same thing there. That can be a very nice business. Nothing wrong with that. But from an investor standpoint, we want blue sky limits. We want something that is, you can scale forever. You can go global with it. You can address a big market instead just of addressing a Me Too market somewhere. And I'm coming back to my sectors that I mentioned before. Africa, there will be a huge market in Africa alone in health tech, in ed tech, in fintech. Also in areas where you're also strong is like agricultural products. So there's a couple of sectors where I think you can actually outcompete other companies in the world because you have a very strong market in the African continent, and that will attract investors.
Interesting. And from your end, you're sitting in South Africa in Cape Town at the moment. What are you seeing, Manuel? The hot industries.
I mentioned a lot earlier. I think, look, the obvious hottest sector is fintech at the moment, with two prominent kind of exits and everything around this that people are looking at. But it's always a question of perspective, right? So obviously that means it's more competitive. Yes, there's more capital around it, but there are lots of sectors that have very unique problems and are big, and just no one is paying attention to it. Healthcare is a great one. It's only starting in Europe now, and in the US to gain traction. And the problem sets are very different in the South African or African context. And there are lots of other topics like security. We're leading in South Africa in crime. Probably not a KPI to be proud of, but that means on the flip side, the security industry is big. Like the private security industry, there's interesting case studies all around that from a hardware perspective, from a software perspective. So I think I wouldn't shy away from big problems in big markets that don't have a Me Too product, as Hans was alluding to it, because that's how you can build a real winner. It might take longer, and you probably have to convince a couple of people around it, because human behavior still kind of very often follows a certain pattern. But I've seen very interesting entrepreneurs and businesses that you only understand if you're on the ground, and you understand local market circumstances, if you understand local trends. But there are lots of problems, small or big, and interesting businesses to be built to solve those problems.
Okay, my last question, I'll stay with you. My last question would be, what has been your biggest failure, and what takeaway would you give to our audience? What has been your biggest failure, and what can we learn from that?
So lots of failures, but let's start with one that's on topic, which is the first business I started. I raised way too much money.
Sure.
So
that's a nice problem to have.
No, it's a terrible problem. It's not a nice problem at all. So we raised way too much money at way too high valuation, which means you set up for failure, because you need to grow into that valuation. So all your new investors want to make a return on it, and if they don't see, then like you're the problem, strategy is the problem. That means you can't build a proper culture, which means you're under so much pressure all the time that it's almost impossible to execute. If I set myself up for failure, because I thought the KPI is raise as much money as that most highest valuation. It's a young ecosystem. I was young and stupid. Now I'm still stupid, but like a little bit older, at least a little bit wiser. But it's really, really kind of finding that balance is an art to really understand, why should I raise capital? How much? For what? On what timeline? And it's not a good problem. It really isn't.
Sure. Thank you. Thank you so much, Hans. The same question to you as we close off.
Yeah. So I think the venture capital is built for failures, right?
Sure.
We know companies are going to fail, and we appreciate that the entrepreneurs tried, right? So as long as you really go for it and still you fail, it's in our model. We're not going to come back and say, we're not lending money. We're in you in the boat with equity, right? So that's very important to remember, right? So if you go to a true venture capitalist, he knows that he 50% of his portfolio will unfortunately not succeed. So that's built in. But my biggest failure, I would say personally, was that there is a fintech company called Klarna in Sweden. It just raised money on 10 billion US, and I was offered to buy 10% of the company 10 years ago for $50,000.
Oh, I'm sorry.
That's my biggest failure as an investor.
That's very expensive.
Yeah.
Biggest and expensive failure.
But happily enough, I became friends with the entrepreneurs, and we invested later in the company. But if I had invested at that time, it would have been fantastic. We did invest in Shopify at the same time, so we did fairly well anyway. But you also have these anti-portfolio investments that you should have done.
All right. Thank you so much, gentlemen, for your time and for those interesting insights. I think we can hand it back to Lona.
Thank you very much.
Thank you.
Thanks.
Hans, thank you, Manuel. It's always so insightful to listen to you gents speak. The years of experience and the insights into the industry are so cool. So thank you very much for taking the time out of your insane schedules at this time of year to speak to our founders. Everyone appreciates it.
Thank you, Len.
Thanks a lot.
Great. Okay, guys. So we're on to our next session. I hope everyone is fired up as I am after that one. So we're sticking this is to the investment trends. This is our third session in the investment stream before we kind of move on from that. But we've got a dear friend of mine called Richard Sharp here on the line with us today. About 4 years ago, Richard ventured on his own and founded a business called Heritage Wealth Partners, and he'll tell you a little bit more about that. But one of the special things about Richard and the work he's doing is they've got this one fund that specifically targets unicorn companies around the world, and it's had some phenomenal returns. Richard, I'm not gonna take the wind out of your sails, but I do need you to mention some of the numbers you guys have been achieving in terms of that. And without further ado, then I'll hand over to you to share with us how you guys go about it.
Thanks, Lo. I really appreciate it, and obviously, to me, it's a privilege to participate in this forum as well. And to come alongside guys like Lo, who I've had a long-standing relationship with, since there were three founders sitting around a small coffee table. But yeah, we can get more into that another time. I think the first thing is probably, as you'll notice, the stark difference between the marketing photo that Lo showed you a few seconds ago and this one. So that mugshot of mine was taken just over 4 years ago, actually, and just before I founded Heritage Wealth Partners.
It's a wild ride.
So I think clearly the strain of being a business owner is there and evident, and I think it's part of the battle scars, yeah. So obviously, as being a business owner, I know what it's like to be fighting in the trenches. I know what it feels like to be building the plane as you fly it. And I think that really does help us with insight into the types of companies that we're investing with, the types of companies that we're partnering with. Again, I'm sure that I'm talking to the right audience when I talk about battle scars. And I just want to touch on this a little bit before I talk about the fund itself and the process. But for me, my battle scars, there's one of them, a little bit of premature hair loss. I think for other people, for other founders, their battle scars could be that they've put their life on pause while they have started their business, and they're pouring every second, every minute, trying to extract the most out of every second and every minute to get their businesses going. And I know that there are others out there that their battle scars could be a failed relationship, because the person that was there in the relationship with them, wanted them to be there, and unfortunately, sometimes we just can't be there. We're locked up in our office doing the things that keep the lights on, and that's why I think this forum is so important, because I really think that those of us who are part of this are there to support each other and to really keep us account and make sure that we're flying close to that sort of imperceivable line of work and life balance. And I'm very grateful to you, Lo, for this forum. Okay, so enough about my loss of hair. Maybe just to talk a little bit more about why we have the Unicorn Fund. So just going back, the Unicorn Fund was launched at the end of 2018. Over the next 18 months, it proceeded to return about 136% in rands. Obviously, a little bit of that was rand-dollar exchange. It's currently sitting at a return in dollars of 58% over the last 12 months. So those are the types of returns that it has enjoyed. But obviously, in terms of the inspiration of it, I've only got 10 minutes. I could probably talk about this for hours and days, as Lo would tell you. So I think if you want to know more, let's go out, maybe get a late lunch one day and go sit and talk about it again for hours. I don't want to bore you with technical analysis because, again, I only have 10 minutes. I don't want to talk about fundamentals. What I want to do is I just want to talk to you about what I want to bring you behind the curtain and really just try and convey to you the inspiration of the fund and the ongoing spirit as we're managing the fund. So the inspiration was actually born from one of my longest standing clients. They founded their business in 2011, and a few years ago they sold 50% of it for a fairly large sum of money, and they sold 50% of their business to a large blue chip corporation. Just after that sale, I sat around the boardroom table with the two founders and our investment team, and we were actually just spitballing investment ideas because they had some investable capital and they wanted to know what we could do for them. And obviously that meeting went ahead, and at the end of the meeting, when the clients actually left, I sat there with the portfolio managers and I said to them that this is the type of business I want to be investing in. This is the type of business where I can see this exponential growth. And unfortunately, in the retail investment environment in South Africa, it's very difficult to find companies that are that size. I'm going to refer to it later, but Tanya spoke about it earlier, the gazelles. And what I said to them is, I said, guys, I want to find a way that we can invest in businesses with this type of growth, with this exponential growth, but obviously in a way that that is viable for the investment community as well. So by the way, I'm not going to be using PowerPoint. You're going to have to stare at my pretty bald head for a little bit longer. So one of the takeaways that we got from that meeting in terms of what I was looking for was that they were the owners of the business were still actively involved in the management of the business. So they still had their hands on the wheel. They hadn't taken their hands off yet. It was still they still owned a large stake in the business. So for them, it was vital that the business continued to grow and continue to succeed. And also they had now got a large institutional investor. And again, Tanya did mention it. In South Africa, it's very difficult for VC companies to actually get an institutional backer. And this company had successfully managed to do that. So for me, that was definitely one of the keys, because obviously that institutional backer brings with it a certain level of financial security, of auditing, making sure that the books of a company are correct, and also just being able to back the business if they needed cash, and if they needed a cash injection, or just to help them grow. So what we were looking for is game changers, and now I personally love that word, because it really does bring about the spirit of the type of company we were looking to invest in. So we were looking for entrepreneurs, people who had the vision to disrupt an entire industry, but not only the vision to disrupt an industry, because although there are many people who can do that, relatively speaking, they still need to have a certain business sense and a business capability in order to still drive proper profits. So the first challenge, when you sort of take those metrics, is where do you find these mythical creatures? And again, Tanya did touch on it. The amount of unicorns in South Africa is very limited, and we needed to make sure that we had a broad base of companies that we could invest in. So we put a lot of research. Obviously, research is pivotal to any investment portfolio. We poured resources and man hours into a very focused research framework. And after doing this actually for a number of years, Craig and Tony from Anbro Capital, who we work very closely with, one of our portfolio managers, he drafted the initial document of the Unicorn Fund. Now, I think probably the most prolific name that we have in that portfolio is Amazon. And I think when people hear Amazon, it evokes probably a little bit of FOMO, because we didn't get in early enough. Also maybe a little bit of fear, because then you start to associate with all of the FANG stocks, and people say that these companies have got these extreme valuations and PE values. So Amazon, I'm using it as a specific example because yes, our Unicorn Fund is too young to have been an early adopter of Unicorn. But with the metrics that we've given, if we go back, we see that Amazon actually would have slotted perfectly into the fund. And most likely, can't say for certain obviously, but most likely we would have bought it. As a matter of fact, we still bought it. Even after the fact that the fund was only launched December 2018, Amazon's valuation was obviously already very high. It still met our metrics, and it still does today. So we still hold it. In fact, it is the only holding that we have in the sort of general FANG group. We're not holding any of the other companies in there that don't meet our metrics, but Amazon still do, and obviously is still growing. So what are we trying to achieve? We're trying to achieve that type of growth, that type of business where they have this large runway, and they can really have an exponential growth into obviously the potential that they have. So I don't know how many of you, and unfortunately I can't say, raise your hands because I can't see any of you. I don't even know how many people are still watching. But I don't know how many of you have heard of a spiffy pop. Probably not very many of you. It's not a interesting Japanese sucker. It is actually a recent term that was coined. And basically what it is when your daily share price increases by more than what your original purchase price was. Okay, so as an example, I'm trying to give you some of those. So two of the shares that we've purchased that are in the portfolio where we've had these spiffy pops. One of them is Shopify. Probably a lot of you are familiar with Shopify. We purchased Shopify at $138 a share. It recently hit its high of $1,146 a share. Current price is $931 a share. So we made over 700% profit on that one share. Okay. Zoom, I really like the story of Zoom. We're all using Zoom now. And actually that was one of the fundamentals that we looked at in the portfolio, was to say, what are technologies that we actually want to use? Because if we want to use it, the chances are other people want to use it, and the likelihood of it being successful is quite high. I'm not timing myself, by the way, so you must just get the thing and tell me when.
We're on our last minute, Richard.
Okay, so Zoom, again, the type of technology that we used. So we liked it, so we bought it. We were relatively early adopters of Zoom. We bought Zoom at $62 a share. It hit a high of $588 a share, currently sitting at $415 a share. Again, about a 700% profit on that share. We're still holding it. There are 81 shares in 11 different sectors, but they're all our type of people. They are entrepreneurs, business owners, disruptors, and obviously that for us is pivotal. So what I would love to do, and I'm actually going to approach Tanya about it, is I would love to have a vision of a South African version where we can buy some gazelles and hopefully turn them into unicorns. But if you want to know more, you can get hold of us, or you can get hold of Lo, and I'm sure he'll put you in the right direction. Thanks, Lo. I appreciate your time.
Brilliant. Thank you, Richard. Thanks for being here with us today. Always great to just kind of hear your insights in terms of where to look for good returns. I think 2020 has been a year where returns have generally been kind of mixed to pretty bad all around. So congratulations on the huge success you guys have had with backing big entrepreneurial companies in terms of that. So for all the founders out there, when you do your big exit, Richard is probably your man to speak to at that stage.
That would be great. We'd really love to help.
Great. Thanks for being here with us today. Appreciate it, Rich.
Thanks so much, Lo.
Brilliant. Cool, guys. We are heading into our last session ahead of the break. I'm going to ask our co-founder, Donna Pretorius, to jump on with me, as well as Sethugani and Sean, two of the star players over at Investec. Sethugani and Sean head up the CSI department there, and they have a big focus in the entrepreneurship kind of side of things, that where Investec supports multiple entrepreneurs through a lot of interesting processes that I'm sure they will tell you about quite a bit. But yeah, we're looking forward to hearing from them. Just kind of like, why are corporates in a place like South Africa, getting involved with entrepreneurship? Why is it important that big business work together with small and mid-sized business to make this economy work? Gents, over to all of you. Excited to hear your thoughts.
Thank you so much, Lo. Sean, Sethugani, so great to have you here today.
Thank you for having us, Dana. Good afternoon.
Good afternoon. Sean, can you quickly also just quickly show your face? Can everyone see you?
Sure. Yeah. Is my camera not on?
Wonderful, Sean. So great to have you as well. So quick introduction. Lau also mentioned Setlugani Manchiri, the head of corporate social investments at Investec, and then also Sean Milano, who's also a CSI portfolio manager at Investec. So great to have you gentlemen here today. Our biggest theme today is going to be why corporates are supporting entrepreneurs right now. Setlugani, I would love to pick your brain and give the floor to you firstly. From your point of view and experience, Setlugani, why do you think is it so important for corporates to support entrepreneurs, specifically now?
Thank you, Dana. I mean, I think the most important point is that the support of entrepreneurship at all times is key. It's key because, put simply, entrepreneurship enables people to become active economic participants in any given society. And that active economic participation of individuals really has a massive positive effect on them. Their sense of purpose, their sense of contribution, sense of direction, sense of dignity, ability to put bread on the table returns to them. So it is important that we try and facilitate the active economic inclusion of as many people as possible. And I think, why now? Now more so because we're not quite yet out of COVID-19. We're not speaking of post-COVID-19, but I think the fact of the matter is we actually are going to have to rebuild. We are going to have to pick up the pieces. With or without COVID, we have to pick up the pieces. And part and parcel of picking up the pieces, as we face huge unemployment rates from country to country, more so in a country such as ours, with youth out of jobs, we really have to support emerging entrepreneurs. You know, government cannot continue to be the employment agency that it seemingly has been for many years. It's just not sustainable. The majority of jobs that are to be created by entrepreneurs. The support of entrepreneurs means that you're going to have a lot more job creators as opposed to more job seekers. And that's what this is about. We've got to support entrepreneurship in the face of what we are going through now, because critically, we have to have as many people who were initially active economically returning back to active economic participation in society. Thanks, Dan.
Setlugani, that stands so much out for me. Sean, if you were to add anything to that, why you think corporate should support entrepreneurs specifically right now?
Sure. I think for me, Donna, it extends beyond just the right now, because that's what this whole thing is all about. I think it's about sustainability. Nobody operates in a vacuum. No business operates in a vacuum. No individual operates in a vacuum. So, you know, in terms of, we're talking about, you know, economic participation and engagement and, you know, new business and entrepreneurs, you know, if corporates and businesses aren't investing within the communities that they operate and work within, there is no place for business. So there's nothing to sell, there's no market to go to, there's no one to procure services and products and things like that for, because you haven't built a sustainable model. So I think even, you know, the title of why corporates should be doing, or even in its title, corporate social investments, I don't think it's just necessarily left at corporate. It's a social impact and a social responsibility and engagement. So, you know, I know obviously with entrepreneurs, you know, you're really chasing the next deal and the next, you know, trying to keep the lights on and things like that. But I think it's the way in which you do things. So it doesn't necessarily have to be a big CSI department or, you know, like Investec, for example, in terms of some of our major projects that we've been running for very long periods of time, but just thinking about how do I want to operate? What does that look like? And how do I take those small, meaningful steps that creates that sustainability model that enables everyone to operate within this economy and within this marketplace and within business itself? So, yeah.
Thank you so much, Sean. Setlugani, my next question is to you. Setlugani, why does Investec have such a great heart for entrepreneurship? What's the why with regarding to entrepreneurship at Investec?
Well, Dana, we were born out of a spirit of entrepreneurialism. If you think of Stephen and the likes who've come before, the CEOs we've got now, those were entrepreneurs at heart. And we embrace at heart the entrepreneurial spirit. We believe and understand the extent to which it can make a difference. It is so much an extension of who we are.
Yes.
Children would know, many of those who are employed in Invest would know that they're not quite typical employees of a place. They are entrepreneurs within an enterprise that embraces and allows them to really show up in many different ways in pursuit of solving problems, in pursuit of addressing clients' challenges and the likes. And therefore, that's why for Investec, the playing in the entrepreneurship space is not new to us. It's an extension of who we are. It is so much in our DNA. I mean, only I could show you. I mean, this is like flowing through the veins of our, it is who we are to the core. And if anything, if you hear anybody talk about entrepreneurs and the way in which we practice entrepreneurship at Investec, you'll realize that, my goodness, this is what made this place. This is why this place exists. And look at it today. It employs thousands and thousands of people, not only in South Africa, across the world. And we believe in it because we've seen it happen before. And the significance of facilitating similar kind of creation. We always talk about where's the next Brian Joffe going to come from? I've got to come an extension of yourself as being entrepreneurship.
Sure. Sean, I would love to hear your take on that as well.
Yeah, exactly like Sid said. I think for those who may be a bit more familiar with Investec, you'll always hear about culture in our organization. And that's really what it is. It's an entrepreneurial culture where you're not just a typical bank employee, scanning your access card in and out. I think the DNA, the energy, what Investec is about is intrinsically entrepreneurial before anything else. So it's about understanding how to do things in a smart way, in a different way that kind of is unexpected, but achieves extraordinary results. So I think, being at Investec for as long as I have been and set even longer, and, I think it's testament to that fact that it's truly an organization that is exactly what all entrepreneurs are all about, thinking sharp, thinking on your feet, being proactive, not just reactive, finding solutions, understanding how to pivot and how to navigate through uncharted waters, and not being afraid of uncharted waters as well. So I just think Investec is all about that. So, some people are sometimes, surprised that Investec is playing in the entrepreneurial space. And that's really just because we don't stand on a soapbox, trying to tell every man and his wife about what we're doing, because we believe in terms of the impact that we're doing will speak for itself, and the projects will talk to that. But it's really, like Sid said, it's just part of the building. I mean, the energy, even now with the building being as empty as it is, in the Joburg office anyway, there's still very much a vibe and a buzz that you always get, and the energy is really linked to that entrepreneurial spirit.
Sure. Thank you so much for that, Sean. Sean, as a portfolio manager of CSI programs specifically earmarked for entrepreneurs, would you be so kind to elaborate on some of these programs? We know Alto CFO is gladly partnering on some of these programs with you, but just for the listeners, the audience, just to elaborate a little bit about some of these amazing programs that you're running for entrepreneurs.
Sure, of course. I'll elaborate on the most amazing ones in partnership with OCFO towards the end, so I'll definitely toot the horn there. But I suppose one of our flagship programs that we have, and it has probably been the biggest one that's impacted by COVID, just by virtue of what the program design was our Global Exposure Program. So this was an exciting, innovative, first of its kind globally from the exposure that we've had anyway, where we look to take entrepreneurs, South African entrepreneurs across different sectors to global destinations around the world, where there is amazing sort of thought leadership and processes within that specific sector, all with a view of these entrepreneurs getting global exposure and coming back to South Africa with a very different context and understanding and lens of how they can enhance and get their business, as well as even new market opportunities as well. From that, we also have our different pipeline programs as well. So again, it's not just about, we're all about a relationship and building a partnership and going through a journey with South African entrepreneurs, which we've been very, very fortunate to do. So we've got a fantastic alumni base across multiple sectors. We're also working with the Graduate School of Business in Cape Town, as well as Stuart Cohen, who's the co-founder of the Mr. Price Group. Him and Chris Hoskin have with the co-founders of Startup School, which is an online entrepreneurial learning program, and very different to a lot of online programs, even if I do say so. And that's given us amazing results from entrepreneurs in sort of startup phase, And then we have our amazing programs with you guys, Lo and team, on our Access Finance Readiness program, which enables entrepreneurs to access finance from some of the likes of the investors that are on this panel, as well as giving them access to market opportunities as well. So that's just a flavor of kind of a very high level in terms of some of the programs we're running under the entrepreneurship banner at Investec.
Thank you so much for elaborating on that, Sean. I would love to give the final word to Setlugani. Setlugani, I would love you to give some words of encouragement to the listeners today. Some of them are entrepreneurs, some of them are founders themselves, working very hard in their businesses. Some are network partners, some of them are investors. Just some word of encouragement from your side for the year to come also.
Well, I mean, suffice to say, entrepreneurship is not the easiest of journeys. And as we now emerge with a new normal, with or without COVID, with or without vaccines, the reality is times are going to be much harder, much tougher. But the key remains, and I most probably am preaching to the converted, that in any good crisis, I consider it to be, we should not waste it because lies way too many opportunities. And not everybody is wired, I may add, to see these opportunities. But a lot of people that I'm addressing this afternoon are the kind of people wired, very well inclined to see the kind of opportunities, even in the most darkest of clouds. So the only silver lining, many of us ordinary people will wake up, will work from home, will work to an office, hybrid, whatever will happen, but will not see this. All we'll see is doom and gloom. But the people sitting virtually so this afternoon with us are people who are able to see the silver lining. And the thing about it, they will also appreciate that the window of opportunity only opens but this wide. Okay? And don't tell me, Lo, don't tell me, all colleagues, that what a lost opportunity, what a lost. Opportunities are never lost. Opportunities are taken by those who want them the most. And it is this lot of people who are better wired, who are more hungry for opportunity, who should be taking advantage as we emerge out of making sense of COVID-19 and its ramification to say, where to next? What next opportunity is going to be? So please, I plead with you, never waste a good crisis. This, as bad as it may be, lives have been lost and we are saddened by that, and we've been shaken in many ways than one. But my goodness, what a gem of a crisis this is. And only you people will understand what a gem of a crisis this is. Fully utilize it for what it is. Please don't waste a good crisis. Thank you.
Thank you so much, Setlugani, for that words of encouragement. Sean, thank you so much for your input. Such amazing gems. So great to pick your brain. Again, it's so great to partner with Investec on these amazing programs and to really see the heart that you have for entrepreneurship.
Thank you very much, Don. And
thank you. Thanks for having us.
A great team.
Over to you, Lo.
Thanks for all of that, Sean. Always really inspiring to you guys speak about entrepreneurship from your perspective, and thank you for those big words of encouragement as well for everyone on this call everyone here is in the trenches, right? Guys, so this is the official last session before we head into a short break. We've got finance for founders. We've asked one of our co-founders, Jock, to have a chat with our head of advisory, Uwais Asmal, and the two of them are going to have a little powwow on, what is finance all about in this world of entrepreneurship, and what is the role that kind of finance and the numbers play in building a successful company. Gentlemen, over to you. Very excited to hear your thoughts.
Thanks. Hello, everyone. Thanks for having us. So as Lo mentioned, my name is Uwais Asmal and I'm the head of advisory services at Outsource CFO. My colleague joining me, Jacques Legrand, is director, and he's got many years experience in helping SMEs with accounting and CFO services. And he's also got experience in running that OCFO business. So he's got that similar entrepreneur mindset that all of you have. So Jacques, I'm going to pull on that knowledge strings just a little bit. If you can just share with us, what do you think are the key elements of building a world-class finance function? Over to you.
Yeah, awesome, Uwais. Yeah, so I think firstly is maybe also just to think, why do you need a world-class financial function in the first place? And I think the finance function, it's not what brings you in your bread and butter, but it is that necessary thing that you use to steward the business that you are driving. And I think some of the key parts of a financial function is processes and people, just like with any other part of a business. So obviously getting the right people in that has the right skill set and knowledge to drive it. And then over time, putting that into processes as well. And I think generally we would obviously be looking at things like historic information, but then also looking at the future. So on the one side, if we can measure it, we can manage it. We all know that very well. Looking at the historic information and how to communicate that to other stakeholders, whether it's shareholders or other management or divisions within the business. It's so important to, one, know what's going on in the business, but then have creative ways of communicating that to other stakeholders, because that knowledge gives that insight to inform them how to go about their decision making. And then the same with that, doing it in terms of future information, forecast, cash flow, that type of thing. So I think on a high level, ways, that's some of the things that I would say is definitely key to building a strong financial function.
If I can also maybe add some of my thoughts, you also need a strong base, a strong financial base. And if you don't have a strong financial base, you're never going to get that world-class financial function. If you're not getting regular management accounts, then don't waste your time with the rest. If you're managing your cash from your bank statement, if you're not doing things like cash flow forecasts, if you're not doing things like income statement budgets, you can't have a world-class financial function. I think also for me, if you talk about world-class financial function, that finance person should be part, it shouldn't be a silo, it should be part of the business. Also, they should be thinking equally, if not probably more about the future than about the past, because the past has happened, it's done. Yes, there's things that need to be recorded, but if your finance function is not helping you make decisions about the future, it's not a world-class finance function in my mind. Things like tax planning, there's a lot more other things, systems integration. Like if there's anything related to manual intervention, then you don't have a world-class finance function. The scary thing is you even get some listed companies where there's a lot of manual intervention. And that's one of the things that we want to eliminate by having automation in that function. And
yeah,
so, sorry, carry on, Joe.
No, just to add to that, so like you mentioned, in terms of just automating that function, there's obviously a place where in the current age and day, the digital technology that is available allows us to automate so many things. So that makes it possible to get that information at your fingertips and to make that quick decisions. Another important thing with that, apart from just automating it, is knowing what is that key figures that you have to keep your eye on. Sometimes there's so many different reports, so much information, and you need someone just to guide you through, walk you through what are those key metrics that you need to keep an eye on to drive the business growth and get to that goals that you have set out as a business owner or entrepreneur.
100%. A lot of business owners have medium to long-term strategies. Those financial forecasts, you need to have forecasts that tie into those strategies. Otherwise, it's just a dream and not a plan. And like they say, if you fail to plan, you plan to fail. If I can maybe ask you a little bit more about what more can you teach the audience about finance?
Yeah,
considering the audience that we have.
I think depending on the size of business that you have, but to at least know what's going on in your business. For some business owners, the old school way would be to check your bank statement or bank transactions every day. And in that way, you could manage or just have insight into what's going on for maybe some of your smaller companies. But then as a company or entity grows, it obviously becomes more than just a bank statement in terms of looking at that. And then to know what's going on, and that comes back to that key metrics that one should have, whether it's sales, a number of type of transactions or sales that's happening. Sales is obviously the lifeblood of a business, so definitely to have your eyes on that and to have that updated information and being able to measure it. Many times we find businesses where entrepreneurs run it on their gut. And I think that is a very important thing to have, because you have to have a feel for your business. But many times that can become skewed because of a number of variables. And that could lead business owners to make decisions that aren't that accurate, and they can find themselves in quite a predicament. I mean, if you think of the current economic scenario, having that insights into terms of how to steer the business is so important, and to make those quick decisions, whether you are ready to hire staff, or if you're in a place where you need to downscale temporarily till the market picks up. Again, you need to have insights into that. Otherwise, your gut might not always be that accurate, although that's an important ingredient. So, summarize, I would say definitely to have that insight, you need to know, you have to have that surety about what's going on in your business from a financial perspective, and together with your gut, your knowledge and feel of a business to run it from there. So yeah, that's what I would say in terms of that.
I agree fully with you in terms of, it also depends a lot on the size of the business. I'm going to say something a little bit controversial, but as a business owner or entrepreneur, you don't want to waste your time with compliance. Your time is valuable. So you want to focus on the things that can grow your business. But if nobody focuses on it, you're not going to have a business. That business will fail. So if you aren't going to focus on it, you need to get someone who you can trust, who can focus on it, but not only just focus on it, think outside the box. Because I mean, bookkeepers and things like that are a dime a dozen, but helping you scale and maximizing your growth, that requires a certain level of financial professional.
And
I'm going to also tap in.
Just
sorry,
to
carry on.
Add to that point that you mentioned, always, I think the big question always is, how as a business owner can you work more on top of a business than in the business? You have different books speaking about the technicians, the operational guy in the business, and that's necessary. And we find that many times first-time founders find that they have the technical skills to run the business or to do whatever drives the revenue. But in terms of running the bigger business, that's a whole different ballgame. And especially when you're starting up, you need someone that can run your finance function for you, to look out for on that part, so that you can work on top of a business, not only in the business. Otherwise, you find yourself seeing opportunities go amiss because you were focusing on working in the business, looking at compliance, SaaS type of things. You don't want those things to keep you awake in the first place, but definitely not to keep you from executing on opportunities that's at hand. So it just speaks again to that importance of, especially if you're a scaling business, if you want to go big in that sense, you definitely need a strong financial function so that you can also work on growing the business.
I'm gonna pull on your knowledge a little bit again. And I want to ask you, can you give us an example of somewhere where your client's gone wrong, or an example of things? Because I know entrepreneurs, sometimes, I mean, you have to move fast, you have to make decisions quickly. Can you give us an example of something just to help the audience in what not to do?
Well, yeah, I mean, I think firstly, like many speakers said, it really takes courage to be an entrepreneur and to get your hands dirty. So firstly, respect. And I think everyone doing it out there took huge risks in various areas of their life to commit to this journey. And sometimes it can become such a lonely journey. And I think one of those things is not to go at it alone. And what I sometimes find is that entrepreneurs have support, but when it comes to their financial side of their business, they tend to want to keep that to their chest, which makes sense. But sometimes they carry that burdens on their own. And if you have someone knowledgeable, which you can bounce ideas or strategies against, that helps a lot. And to also test some of the assumptions that you make about your business. General thing is, normally, just like in life, we never just climb into a car and drive somewhere random. We know where we want to go. And I find that many times entrepreneurs, they get into survival mode. They just want to stay alive in that sense. And they tend not to plan ahead, whether that's cash flow, which is obviously key, having that cash flow mapped out for the next while, knowing how much leverage you have in terms of that is a big thing. And then next to that is obviously the difference between profit and cash flow. I've seen so many times businesses showing a profit, and then they're surprised that they don't have cash at the end of a financial year or whatever period it might be. So I think there needs to be a place where, as an owner, you need to take end ownership of your business. Yes, you can get an amazing CFO to help you, but you can't expect someone else to do what you're supposed to do in terms of understanding what's going on in your business. You can get someone to guide you, but it is your responsibility to understand what's going on in your business. So I think one of the things sometimes is people would like to outsource that responsibility as well. And I find that where that happens, founders or business owners can heap up problems in the sense of that, yes, you can get someone to give you insights, to tell you exactly what decisions to make. But I guess in that sense, you have to make decisions based on the financial information given to you, and you can't expect someone else to make them on your behalf.
Nobody's going to love your baby more than you.
What would you say are some of the things that you've picked up with us?
I said one of the experience a few years ago where one of my clients had two separate companies, and they make decisions quickly. The one was loss making and the other one was profit making. So they thought, okay, they'll quickly transfer the employees from the loss making company to the profit making company so they can save tax. And luckily we stopped them before they did that, because they didn't consider all the HR risks, all the basic condition of employment tax risks. It would have ended up being a lot more expensive for them to transfer the employees, and a lot more cost, and potentially getting them taken to the CCMA or things like that. So I'm glad we managed to stop them in time. And if you have someone that you can at least run a theory, because I mean, obviously you've got ideas and you need to move it, but at least you have someone that you can run your theories by, or what would happen if I did this? What would happen if I did that? If you have a partner that can help you, then that's great. I think that's probably my final thoughts. I don't know if you've got any final thoughts for the audience?
Maybe something that I would love to pick your brain on. Obviously, being head of advisory, you've worked on a number of businesses, doing a various gap analysis on them. What would you say is the top 3 things that you find in businesses that business owners tend to maybe not be aware of or see as blind spots, generally speaking?
So it also depends a lot on the size of the business, because the bigger the business gets, SARS will find you. But I mean, in the smaller businesses, generally dealing with the tax or not being tax efficient, paying too much tax potentially, or they're not using the things that are available, the normal ethical things that are available in the legislation to save on tax. And I mean, cash is king. If you don't have to give that much money over to SARS, then you can employ someone else, or you can take leave at the end of the year, go away somewhere with your family. I think managing the cash flow, people don't, a lot of them, like you say, manage their cash flow from their bank account, and that's very risky because you don't know what's coming around the corner tomorrow, next week, whether it's VAT or PAYE or bonuses or something like that. Whereas if you can at least plan your cash flow, you know what's coming. I think that those are 2 that stand out for me.
And maybe just to add on to some of the previous speakers, I think it was Manuel Kozer that just said, you can't just try to raise capital, and money is not necessarily going to be the answer to your problems, although cash flow is so important. How do you find, what's the balance between knowing you need cash flow as the lifeblood of a business, but also not only making that your focus? What would you say to that?
Tricky question, I guess. It's an interesting one. I guess having those 5 KPIs that we talked about, your most important being, I mean, your business is not going to be a success just because you've raised funds. You have to be a profitable business. There's lots of businesses around that have raised lots of funds, but are still making losses. And those ones stress me out, actually. I mean, because profitability and cash profits that's proof that your business is a success, not the fact that you've raised so much money. Because a lot of companies, as they mentioned in the VC discussions, 50% of them fail. So they've raised a lot of money, but they're not necessarily successful businesses. They're just arbitrage machines.
Yeah, definitely. And maybe what will you say in terms of closing remarks on the topic, takeaway, or one last comment maybe from your side for the audience?
I think for the audience, I guess I'd say you're the entrepreneur. You think outside the box. So get someone who talks your language. You get a partner who talks your language, who understands, who can explain to you things not in accounting language, because that's not going to help you. Explaining to you why it's important to you to be able to do certain taxes or certain returns, or for them to pay for those things. They must be able to explain it to you in how it benefits you, not in why it must be done from section this of the Income Tax Act. As an example, I think that will be my final words.
Okay, everyone, and we are back. Welcome. I hope you got a proper strong coffee. We made it a bit of a longer break than normal just because we're just doing the one pit stop in the 3-hour sprint. But yeah, I'm very stoked about this next session coming up. And I hope everything to date has been interesting and valuable. I think there's a lot of golden nuggets and a lot of notes I know that I've made on this side that's going to form part of our thinking for the future. So this next session, let me get the guys on the screen for you. Is going to be a very interesting one. We're going to basically be covering the topic of exits. How do you build a company in order to sell it? Like, how do you build for sale? So we have got Simon Hartley from OneDrop with us, and we've got Dustin Graham, who's the managing partner of Benchmark International. It's wonderful to have you gents here with us today, and I'm excited to kind of like just hear some of the insights that you guys have to share with our audience today. Gents, how are we doing?
Very well, thanks. How are you, Lo? Hi, Dee.
Great. No, good to have you. Good to see you. Hey,
Thanks,
Dustin.
Just a point of introduction, Simon. Your photo looks a lot better than mine. I look hideous. The point of changing that.
Thank you. I took pains to provide a pre-pandemic photo. Key.
Yeah, well done.
That's a clever move. I think all the founders can learn from that for sure. Okay, James, let's kick off our session. Simon, like, OneDrop 2020 has been an interesting year, guys. For all of you guys who haven't met Simon yet, he's one of the most interesting founders I've come across in all of my years. So Simon, first up, we'd love to just kind of like hear, OneDrop must have been exploding in this year. Tell us a bit about the company as well as the journey to date, and then just, what 2020 has been like for you. Thanks,
Lo. Well, the journey to date, really punctuated by a business that was incredibly painful and hard and difficult to run until it wasn't. It was like running into a brick wall until the brick wall disappeared. And there was very little time change between the portions that were awful and when it got good. And in retrospect, it's fairly obvious if you follow two-sided marketplaces or transport marketplaces. The reason why, it's because the easy part of a business like ours is not the technology. It's not the transport part. So creating the technology is kind of what people tend to focus on because it's exciting and it's sexy and it's interesting, and certainly it's fun. It's nice to make stuff. It's nice to make product. Those are brilliant meetings. I mean, like anyone who starts a business has kind of a far horizon, hopeful sort of personality, and they like to create things, and it's a creative experience and feels good. So that's what people tend to get excited about and focus on. That being said, while final mile transport, which is what OneDrop is complex, it isn't rocket science. And the pieces that make up the components of a UI to place orders or ingest orders via API or a CSV uploader or any of sort of 10 methods, the backend logic and the dashboard for the controllers and the driver app, etc. Well, all those components are difficult and complex to make. they're not rocket science, and they're all readily available and can be purchased, or you can purchase the time of a development team to make them. It's relatively commoditized. What we didn't know, because we didn't have any experience in transport when we started this business, is that the real hard part of our business is creating a sustainable driver network that stands up, that doesn't churn, that is loyal, that has good IP, that is reliable. That's both incredibly expensive and bloody hard. It's cool to say that we're going to be the Uber for deliveries, but it gets pretty real when guns are being stuck in your drivers' faces, when the Johannesburg Metro Police Department is pulling you over and then robbing you, which is both surprising and bad.
Wow.
Yeah, that happened yesterday. Yeah, those are the kinds of daily issues that you face, and that's quite apart from trying to keep a driver's attention, of keeping them coming back the next day to do work, because in a two-sided marketplace, traditionally they're not employees, because the unit economics of making them employees and to begin with would be incredibly expensive and wouldn't work. So it was hard until we got product market fit and we got driver network density. It was very difficult. And now that we have driver network density, and in fact, we got driver network density probably around the end of 2018. In 2019, we got profitable off the back of finally having enough drivers and enough time and space with enough deliveries such they earned a livable daily wage, which kept them coming back, kept the driver network with high blood pressure, as it were. It meant that our time to serve our customers reduced and the quality went up. I mean, our Google reviews have gone from like 2.1 in 2017 to 4.4 now. Which is simply indicative of the proof of that mechanism, right? That if you have more driver density, if you have better driver density, then your time to serve your customer, your accuracy to serve your customer increases in our business, and the experience gets better for everyone, and you're more likely to attract more business, which is what we did in 2019. And then 2020 came along, and we had found product market fit with retailers mostly, but not with any food delivery like grocery, because it's really hard. Let me qualify that. The unit economics of grocery delivery aren't as attractive as delivering something like an appliance. You deliver a fridge, the process flow is relatively similar to delivering a packet of groceries. The difference is you get to claim, you get to scalp 180 Rand GP for delivering that fridge, whereas you only scalp about 10 Rand GP for delivering those groceries. So all of the back-end functions, etc., the platform costs, the automated communication, all that stuff costs the same, but you have significantly lower earnings. So we didn't focus on that market segment. And then the government decided that all non-essential deliveries need to stop, or should stop rather. And we found ourselves in April 2020, after going on a tear of growing by hundreds of % per month year on year, in both profit and revenue, to going to pretty much zero in April 2020, which was a hell of a wake-up call. We realized that we were severely, we knew that we were severely under-indexed already in grocery and fast food. If you hear me saying QSR, it's a jargon habit that means quick service restaurants, basically fast food. We were severely under-indexed in QSR and grocery. And so we went hunting for customers. And we are lucky that regulations changed after April, and we were able to get back to our sort of traditional retail delivery. But we've ended the year with KFC as a customer, with Burger King coming on as a customer in a couple of weeks, and meal kit delivery businesses joining us for trials, which are beginning at the end of November and the beginning of January. Which is significant growth, and we're really happy about that development. We're not the kings of grocery delivery by any means, but from an investment portfolio kind of point of view, we're a bit more de-risked now than we were at the start of the year. So the shock was good for us, and as you kind of intimated, deliveries have never been more relevant. So in addition to us kind of taking the structural changes that we needed to take seriously with regards to our client portfolio, the rest of our business has grown significantly. So on balance, while it's been traumatic for everyone in general, for us in particular, it was, I hate to say it, psychopathically, a very good year.
Thanks, Simon. I mean, as you guys can hear, obviously not an easy journey throughout, starting, building out and scaling a company like this and facing a year like 2020. But great to hear that share and see the journey. Dustin, over to you. I want to hear a little bit about, want to hear a bit from the authority in selling companies. 2020 must have been an interesting year in that landscape as well. We'd love to just kind of hear, what is the market out there like? Are founders selling their companies this year? Is it going up? Is it going down? Like, how must entrepreneurs who are trying to build sellable companies think about the landscape right now?
Thanks, Lo. Do you mind if I just respond to Simon? I think Simon's story was, I like to use examples when we do these sort of things, and there's no better example than Simon at the moment, who's just told his journey. So there are a couple of things that I wrote down in his conversation with us now that I think are super relevant for anyone who is in an early stage business that's looking to build to sell. Just going back to the sort of title of what we're talking about today. So Simon introduced this brick wall idea right in the beginning, this brick wall that all of a sudden disappeared. What we refer to that as in an early stage business that is trying to develop. I mean, we did this 10x conversation a little while back where a lot of pressure is placed on founders to 10x their business continually. And I just don't understand what that means. Growth in early stage businesses is not linear. It's just absolutely not. And we find that people bang their heads against a wall, in Simon's case, a brick wall all the time, until one day it just explodes. Yeah. And it just comes out and everything, all the mist kind of clears, so to speak. Right. So that was super relevant. How he got there, we talk about business fundamentals. So we talk about what to focus on. Simon was talking about the tech pieces actually being the easy bit, but the sustainable driver network being the hard part. In other words, getting to his product market fits and his driver density. Those were the hard parts, but he focused on those, if I'm right, Simon, he focused on those primary fundamentals all throughout the establishment or growth of his business. When that all came together in a piece of magic, that's when profitability started to come to the fore. So when we're talking about building for sale, that is a strong focus on the core business fundamentals, which I think is awesome. Then, just carrying on with Simon, being classified as a non-essential delivery service. That's a macroeconomic obstacle that was put in your way by a government within this jurisdiction and one of the most difficult climates to start and run a business, right? South Africa. But because of, dialing back, because of those fundamentals, because of the team's ability to what we call adapt to whatever's thrown at you, he was able to, and I hate the word, but pivot anyway, and change and react to it. Okay, and then I'm almost done. And he ended off by saying that we are de-risked. So that's perfect. So Simon's definitely stepped up, and not to say it, but would be at a trigger point now where capital reinvestment or growth capital could work potentially in his business because he's established that he is somewhat de-risked. So fantastic story, man. Well done.
Thanks. Thank you.
Yeah, you've ticked all the text box pieces, along the way, hey, for perfect scale.
We can finish the session early, guys.
yeah, we can finish. You've read the book. Okay, so your question, how has it been? I forget the question. How has the market been?
Yeah, what is the market like in 2020? Are companies selling more or less than before? Like, what is the, how are investors and entrepreneurs reacting?
Yeah, okay. So I think the main observation we've made is that some of the old methodologies, or many, in fact, of the old methodologies that we all grew up with are gone. And I don't want to say they've changed. I'm going to tell you they're gone. So it's almost like I feel I'm a little bit redundant. You called me an authority in this. I almost feel like I'm redundant. Everything we learned in the past 10 years about how M&A worked is kind of tickets, right? So borders, territories, they've all merged. That's one massive change we've seen. So we have never seen the amount of interest in South African assets from abroad I've never seen it before until now, until this year's hit. We knew it would come. We saw it coming, but not as fast as it happened during COVID. So that was amazing. We saw companies or interest being expressed from offshore territories in diversified assets here. Now, we've never seen that. We've never seen companies doing what we call a double leap. In other words, a manufacturer of widgets in North America acquiring a distributor of widgets in South Africa. That never used to happen. A manufacturer would look to acquire a manufacturer, or a distributor. Or within the same territory, a manufacturer might acquire a distributor. But we've never seen a territory and sector diversification happen in one go, but we're seeing it now. So it's kind of territories have gone. what else is interesting? I think deal structures are really changed compared to what they were. And we're still learning this. So if I'm a little bit in the dark about it, I can imagine how founders and entrepreneurs are in the dark about it. We are seeing a lot more of a risk-based approach to transaction structures. So people don't want COVID to happen again. We had a client that we closed towards the end of last year that had a very significant contingent element to their deal structure. In other words, an earnout, or I don't want to be as simple as an earnout, but it was a contingent element, which means they were going to get paid some value afterwards, depending on certain performance targets. COVID came, the agreements didn't cater for that, and they're going to miss out on those targets, which is really unfortunate. Sure. I think some of the structures we're seeing now are being thought of or contemplated or spoken about, incorporate that now. So a little bit different, but on the whole, volumes are up, sectors, certain sectors are attracting more interest than others. I don't want to be sort of a naysayer, but the sunset business models, the older kind of methodologies and business models aren't getting a lot of interest. New businesses, Simon's as an example, tech, SaaS, e-commerce, they're cooking. Traditional older style businesses, unless they've revolutionized, less interest.
Well, you guys can see why Dustin's on the call today. Thank you. That's incredible insight in only a few minutes from what's going on out there in the kind of acquisitions market. That's really, really cool. So Simon, on this journey you just painted for all of us a little bit earlier, I think in about 2017 or so, you guys sold a massive stake to I believe Massmart ultimately, right, through Macro. So I mean, we'd love to, quite early on the journey, that's quite a big, partial exit. I would love to hear just kind of the core lessons you learned in going through that process, and basically just how the hell did you do it?
Flip. I don't really know how I did it. But I know time's short, so I'll focus on the one glaring lesson that came out of it, and then kind of more generally what I would do now if I was trying to sell the story part that I'd be telling. Firstly, I mean, not to make this a completely obvious three-way high five, but I would use professionals now. Selling that stake really was a full-time job. And if my business hadn't been in danger of dying, which is what it was at the time, I mean, we didn't have the driver network at that time. Money was going into a black hole. We weren't completely clear on the product market fit. Selling the business was a full-time job, and I would have preferred if my full-time job could have been trying to get the unit economics of the business right instead of trying to sell it. So now I would absolutely use professionals to sell the business so that I could focus on my day job, that I could focus on what I'm good at. I'm not a professional business seller, so I would do that. The second thing, kind of general lesson that I've learned about what makes a business valuable now, and what leads to a business being valuable, like the core principles, is for us, focusing on the unit economics of our business was the key that unlocked our ability to get the driver network up and running, to find product market fit, because it is the genesis of figuring out all problems for us, at least as a transactional business. So we kind of struck upon a mantra sort of fairly early on the road to profitability. We said it's acceptable to lose money every month for a defined period of time that we give ourselves, but it is absolutely not acceptable to lose money for every transaction in perpetuity. And that's simply that's like your typical J-curve kind of story, but will you have a path out? And by looking at the unit economics, we were able to interrogate what steps do we need to take in order to make every transactional profitable. Well, okay, cool. To make a transaction profitable, we need to lower the pay to X level. To lower the pay to X level, what number of deliveries do we need to be giving to drivers on a daily basis? Shit, it turns out that's the number that we've got to hit for each driver now. Where can we find that is the next question. Flip, we can only find that in that particular area. So now we're focusing on that particular area and we're trying to hunt for business there. And only when we have the ability to stand that area up will we begin to look outside of that area. So it helped us to constrain our territory of focus, our time of focus, because we were working back from what do we need to make a driver interested in order for us to make the unit economics work per transaction. And that unlocked the ability for us to stand up the driver network. And because we have that in place now, I mean, sure, we could invest a lot of money and we could go back into not profitability for the purpose of growth, but there will always be that path back to profitability because we know that we make money on every transaction, even if we're going to invest a lot. And
I love that, Simon. Sure.
Yeah.
Yeah, I think there's a big push back towards, building companies that can both scale and also deliver profit. We're not too far in the recent past. There was a massive push just towards growth and kind of capturing market share, regardless of if this can ever be profitable, right? So yeah, I think it's a healthy shift, and that's definitely happening there. And yeah, I love how you're going into the granular numbers in terms of the data informs the company, where it should focus, how it should build out, and what that route to profitability is. That's really, really great. I want to talk about timing as well before we run out of our time. Dustin, like on your side, like I recently had a founder who was 2 years into business. They wanted to talk to me about selling their company, and I thought it's a little bit early into the game to be chatting about that kind of thing. When is it time to start looking at it from a company's life cycle perspective? When is it too early, and also like when is it starting to get too late in terms of selling?
Yeah, good. So I'll be quick about this. There are so many triggers that are apparent that you have to be aware of when you are making this decision. You mentioned building for scale and building for sale. Those are two different things. I just want to address that quickly. When you're building for scale, essentially you're raising capital into your business. Okay, you are, as a founder of that business, promoting yourself a lot. Okay, you're promoting yourself and your team and the IP that you've developed, and investors are kind of looking to you as one of the cornerstones to that investment, right? So you're surrounding yourself with that. When you're looking to sell, the converse is actually true. When you've got to demonstrate that the IP rests with your executive team and the business that you're leaving behind, and not with yourself. So there's quite a transition to make between those two. If a company that you're describing is 2 years in is looking to sell, it's going to be difficult because a lot of the business have been built around them. They are the nucleus, so to speak. So to convince an acquirer to kind of adopt all of that risk or hand over that IP is going to be really tricky. Yeah. One piece of advice I could give to what I expect our audience is fairly early stage. I would spend a lot of time understanding yourself as a founder, understanding your limitations, your constraints, your strengths, because the minute you can identify that you are no longer the right executive for the role, you're no longer the right shareholder, you don't have the right balance sheets. If you're building this business that is just scaling out of control and it needs a big balance sheet to accompany it, or it needs a high functioning CEO with expertise that you don't have, you've got to have the maturity and the wherewithal to be able to step aside and allow that to happen. So there's a lot of personal development that goes into these things. And I don't think there's enough thought leadership out there to coach individuals that are building these amazing businesses as to when is the right time necessarily to exit. So I don't know. I hope I've somewhat answered your question, but I think I just want to create awareness. That's the number one thing.
That's a golden share. No, thank you very much. I think everyone needed to hear that. Brilliant. Thank you for that, Dustin. Simon, we're kind of on our last minute. If you could share one experience share or one kind of golden nugget with everyone who's looking to eventually sell their company, what would that be?
Get really good at storytelling. Don't tell lies, but get really good at storytelling.
Dustin's laughing. Great. Yeah, the same thing with fundraising, right? It's part of a story. It's as much as much art as science. The guys would say, right?
Yeah, completely.
Good.
Yeah, there's no substitute for authenticity. Just be real, be honest. Best medicine.
Love it. Gentlemen, that's unfortunately all we have time for today. I wish we could spend an hour on this session. I really enjoy the flow we've got going and the thought process from both of your sides. But thank you for sharing your nuggets in this short space of time and for all the insights. I'm sure there's a lot that everyone can pen down from it. Thanks a lot.
Pleasure.
Thanks, Dustin.
See you.
Okay, cheers, Simon.
Okay, let me just quickly get this back up. Okay.
Hello.
I see. How are you?
Good. How are you?
Brilliant. You can jump on if you like.
Yeah, I think I'm on. Hey, I should be.
I think you're on. Mike, can we get on Spotlight? There we go. Great. Brilliant. Great. Thanks for being here with us today. We're very excited to have you. Very excited to pick your brain on, I think, one of the topics that it's really like on every second founder with a significant company's mind at the moment. You know, just thinking about it from a global perspective, I think, you know, we've all learned you have to build a globally relevant company for the future. Now that, as Dustin mentioned, now that, you know, the world is one, investors and competitors come from all over the world. But how do you go about then structuring your company and structuring your IP for this new world of global business? So we're very excited to just kind of pick your brain on this and learn from you and all your wealth of experience. Thanks so much for being here.
Good to be here. And I liked your last comment when you were talking about selling a business being half science and half art. We certainly see structuring as being a mix of an art and a science. There's very important technical elements, but also some creativity that can be brought into bear. I do have some slides, Lo, so can I share those?
You're absolutely welcome to share.
Okay. So what I thought we would cover today is basically structuring for startups. So the structuring questions for startups are different to normal structuring questions for a larger business. And what we're going to quickly look at is basically what is structure, how do we structure right, what can go wrong, when should we do it, and how much does it cost? So jumping right in, what do startups need to structure for? Some of these are relevant to any business. Some of them are more specific to the startup environment. So the first one is always to reduce shareholder risk, shareholder liability. The second one is to mitigate specific country risk. And we have a lot of South African-based entrepreneurs at the moment who are concerned about the South African sovereign risk and want to look at externalizing part of their structure to de-risk from the South African environment. A key one that we all know about is working in hard currency. Also to work outside of the South African Reserve Bank restrictions, big issue for every business. Particularly of relevance for startups is to structure to maintain your IP outside of South Africa. And that is a tax and an exchange control consideration. Another one is how easy is it to raise funding? How should I set up my structure to optimize my chances of getting funding? Tax, obviously very important. You look at your structure to optimize taxes on all of the group, all levels of the group, including back to the shareholders. And finally, always relevant for startups, and particularly after the last conversation you had, a lot of startups are focused on growing to sell, either the business or the IP, and we want to structure to ensure that CGT is as low as possible. So that's what we want to look at structure for. The next question is, how do we structure? Structure, as I say, is a mixture between art and science. So it depends on your specific company's circumstances, what you do, how you do it, where you do it, and who your customers are. But as a general approach, what we would often look to do is to set up an offshore, i.e. a non-South African company in a jurisdiction which has no exchange control, a place where you can work in hard currency, a place where it's easy to attract funding, a jurisdiction where there's low tax on revenues. Ideally, there's no tax on your dividend receipts so that you will be able to have the offshore entity as a holding company and receive dividends from other group entities, and with low or no capital gains tax. So that's the type of jurisdiction we look for. In addition to, of course, it has to be somewhere easy enough to get to. It has to be stable politically, language, general business environment. All of those things are also critical on the general business side. So the kind of general idea would be you find your magic jurisdiction that meets all of those criteria. I'm speaking to you today from Mauritius, and Mauritius is obviously a very common offshore holdco regime for South African businesses in particular, and it does tick all of those boxes. And then what you would do is you use that offshore company to house all of your non-South African revenue streams. So whatever belongs to South Africa, leave in South Africa, but whatever you can argue is not related to South Africa, let's put it in our friendly jurisdiction. And you also want to use that offshore entity to house your intellectual property. However, the caveat to anything to do with structure is that your offshore entity has to have substance. So that's kind of in a nutshell what we would try to achieve in terms of an offshore structure. The next question is, what can go wrong? And the answer is a lot. And particularly in terms of startups, we have dealt with so many exciting young South African businesses who have ended up in a nightmare because they set up their structure incorrectly. It is really important to plan your structure upfront and to do it properly. So in terms of what can go wrong, the first issue, which often happens, is if you, let's say the startup sets up an entity in Mauritius, but the Mauritian company doesn't do anything, all the key decisions are actually taken in South Africa, then SARS will argue that the offshore entity is actually managed from Mauritius, its place, or managed from South Africa, its place of effective management is in South Africa, which means it then becomes a South African tax resident entity. If it becomes a South African tax resident entity, it is then obliged to register a branch in South Africa, which becomes an exchange control entity. So that is a complete disaster. A lot of businesses have fallen into this trap. They set up an offshore company too quickly, but nothing really runs through it. And then SARS is able to successfully argue that that entity is actually a South African resident company. So all they've done is spent a lot of money and time and achieved nothing. Even if we can get comfortable that the offshore company is not a South African resident, if it is majority owned or controlled by South African resident individuals or companies, then the foreign company is what's called a controlled foreign company, which is a specific South African anti-avoidance piece of legislation designed to stop South Africans trying to move their businesses offshore. And then it could be subject to full South African tax unless it meets one of the exemptions. So that's something that needs to also be managed and thought through very carefully. The third attack that SARS will try to make is in terms of transfer pricing. Transfer pricing is the set of rules that say any cross-border transaction between connected parties must be entered into at arm's length terms. Obviously, when SARS sees a transaction between a South African company and a connected company in Mauritius, obviously SARS' starting point is that that has been set up to try and avoid tax. So they will look at the transfer pricing between the two entities very carefully. In a nutshell, all of the approaches that SARS will try to argue are answered by substance. And if you do not have enough substance in your offshore company, essentially your structure will not work and you will be fully subject to South African tax and exchange control. Therefore, you will have spent a lot of time and effort and fees for nothing. Substance is a very difficult concept. It depends on, there's no clear definition, and it depends on exactly what happens in the business. But essentially, it boils down to having meaningful activities happen in your offshore company and generally having staff in the offshore jurisdiction. So that's what can go wrong. It can be quite scary. As I say, startups are particularly susceptible to this trap because they generally don't have a lot of resources in terms of funds or staff in order to be able to ensure that the structure runs as it should and to ensure that enough substance is overseas. The next question is, when should we structure? Our general question, especially for startups, is don't go too soon. Rather be slightly late than too early. And that's because, one, a structure is a significant amount of money to set up and to run. It is also much more expensive to unwind if it doesn't work or if it's not fit for purpose. Another reason why potentially to delay is that, as you would all know, the loop structure prohibition has now been abolished by the Reserve Bank, and it disappears altogether in January 21. And a lot of the reasons why startups were in a hurry to structure were related to the loop structure provisions. That has now disappeared, so there's much more flexibility from an exchange control perspective. So in terms of a trigger date, it really depends on each specific company, but our general rule is rather go a bit late rather than too soon, because it's too expensive and too messy to unwind a structure that has not been thought through properly or that is no longer fit for purpose. Generally, as a good line, we would suggest that you do not even think about structure until you have substantial non-South African revenues. Once you know that you've got a big pipeline of non-South African clients, that is a good time to start looking at setting up an offshore structure. But you also need to be comfortable that you have staff who can be positioned overseas, or that you will have enough resources to appoint staff overseas. Because as we've said, all of the risks relate to your offshore entity not having enough substance. In terms of how much, depends on the jurisdiction, depends on the type of entity you want to set up. A management company here in Mauritius would typically charge at least $12,000 to set up and run an entity each year, which covers your local directors and your financial statements and all of that. But you also need to factor in travel costs. The directors will have to come over for board meetings. More importantly than the management company fees is the cost of management time and effort to set up and run the structure. And finally, the real cost is when a structure goes wrong. That is when many businesses have rued the day they ever thought of offshore structure. If you set up a structure too soon or without giving due thought to the best way of doing it, trying to unscramble that egg is a nightmare of biblical proportions, and what it costs in terms of fees, tax costs, and management time can be immense. So our advice is always ensure you get good advice up front.
Brilliant. Thank you so much for all of that, guys. I hope no one else is also shivering in their chairs. Be very, very mindful when you attack this global structuring thing, and maybe think about getting someone on board who knows the in and outs pretty well. Steve, thanks so much for joining us today. Thanks for sharing your insights. I know your time is super, super valuable. And I'm sure all the founders here appreciate some of the words of warning and just some of the technical insight you've shared today. Thanks for that.
Thanks, Ro. If I can just add one more point, if it's of relevance to anyone, is that we at Regan van Rooij have actually designed a structure specifically geared at startups who want to obtain the benefits of an offshore structure, particularly around their IP, without all of those risks in terms of substance. So if any of your members would like to contact us to discuss that, we'd be very happy to do so.
Thank you. That's very kind. Appreciate it.
Okay, bye-bye.
Brilliant. We'll connect soon. Thank you. All right, everyone. So we are down to just two keynote sessions to go. Our next guest is all the way from the United States, one of our good friends from over there, Mr. Pepper Bullock. Pepper, we're so excited to have you here with us today. You can jump on whenever you're ready. Pepper's going to talk us through breakthrough outcomes and how to think about pivoting and changing things up in this time. And if I can just say from my own personal experience with him, going through the thought process of thinking about your business in the global ecosystem with his methodology has been super useful. Pepper's one of the best business coaches in America, I would say. So we're very blessed to have him here today, and I'm sure there's going to be a lot of interesting golden nuggets in this session for everyone.
Well,
Pepper,
thank you.
You can jump on with your camera if you can.
Let me do that. Am I on?
Let me see. Yep, Michael. Could we spot that in, please?
Good. Thank you.
Pepper, over to you. Thanks so much.
All right. I appreciate that. Well, good morning, everyone. It's I say good morning. I know it's mid-afternoon for you, but in the States, the sun is just now coming up. So if I may, I'm excited about presenting today. I know that we're a little bit behind schedule, so I'm going to hopefully do all my remarks and get us back on schedule, because my presentation has been made easier this morning because I was listening to the comments of Simon Hartley and the way Dustin Graham built upon what Simon said, this idea of a brick wall. So what I'm going to do is walk you through in my coaching practice and what we teach at our academy here for leaders is really the art of a breakthrough outcome. And so Simon mentions this brick wall he came up to. What I'm going to try to do is I have 10 slides, so I don't try to use a lot of slides, but I have 10 slides that you might be able to have an iconic reference to what are the steps on how to navigate going around a brick wall or going over or going through a brick wall. So if I may, let me put this on share, and Hopefully that's got us on now.
Perfect.
Great. So this is called Breakthrough Outcomes, and it's like we really scripted this whole presentation. It's called the Art of Pivots, because what Simon was talking about was how his company pivoted. The first step is knowing what is your outcome. Truly, what are you trying to accomplish? And so sometimes I say this because you may have a business plan and say, well, my outcome is to make money. My outcome is, Simon Sinek talks about a just cause, whatever that is, knowing what that is. But sometimes in a project, you may get down to you're within a department and you're stuck on something, and your outcome is something that's smaller that leads to this enterprise outcome. So recently I was with a sales team. Because of COVID, they were going out on calls, and they said, well, we can't make our calls. So the outcome is they wanted to make sales. That was their outcome. Once they identified it, and then we came back and we said, okay, what's stopping us from making sales? Well, here in the States, we had certain regulations, flights. So we had a whole group of things. So we listed all these, and your stops can be time, it could be money, it could be resources, it could be we don't have the right talent, whatever it is, you make a list. So in this situation, we ended up with like 15 different things that were our stops. Then the secret to this navigating around a brick wall, the secret of breakthrough, I have found that usually we get stuck because we keep seeing the wall. What I've learned is if I can just go to one brick and just see if I can get through that one brick. So what we do is I encourage to win big, think small. And so out of that list of 15 different stops, 15 things that were getting in the way, 15 different brick walls, we just picked one. We just picked one stop. Then we switched over and started a new page, a new board. We were on the whiteboard, and we said, okay, that's our stop. That stop, getting through that stop becomes our new outcome. Now we're expanding. Now we're saying, okay, if that's our outcome, is accomplishing this stop, getting through this stop is our outcome, how might we? Now we're brainstorming. How might we do this? Okay, well, this barrier is here. I could use technology. I could do handwritten notes. I could do whatever it is, phone calls. So we started listing all the different things. And then once we got to that, we picked one of these, one of the how might we's, and we said, okay, let's take this and apply this. So this, how might we change this stop into a go? Once we solved that one stop, that one little minute stop, we went back and we started over again. We took another stop and said, how might we solve that one? We listed all that, picked one. Then we went back and solved another one. And by constantly doing that, we're putting the pieces of the puzzle. So what happens is, I really like Simon's brick wall. I have to start using that. We hit this brick wall and we took one brick and we just solved that brick and pulled that brick out. Then we took another brick, solved that brick and pulled that out. Then we found another brick, solved that brick and pulled it out. By the time you do this, you solve enough of those micro bricks. What I have noticed is it's really, I don't know how to explain it, but it's like the whole wall starts to crumble, because now it's not a brick wall, it's only pieces of the brick wall, and you find ways to navigate around it. So that's the beginning of a new direction, beginning of a new opportunity, and that's what we call breakthrough outcomes. And if you want further, I have a whole little slide show on this. I can just send you this 7 steps. Just email me at pepper@safeharborconsult.com, and I'll be happy to send it to you. I hope that gets us back on schedule.
Thank you, Pepper. Thank you so much for all of that. Really appreciate your insight, and thank you for bringing us back in line with our time. Really good to see kind of how you break that process flow down to the big monster into the little steps that are actually achievable for the teams. And I know you've done this with so many founder-led teams over the years. It's so good to see it happening in real time so smoothly. Thanks for that. Brilliant. We'll catch up with you soon. All right, let me see if I can get my screen up again for us. Right. There we go. Okay. Can we have the Honorable Mr. Mark Bean on the line with us, please? Guys, we are super honored today. We have not only a business leader, but also a political leader here with us today. I've looked at Mark's CV, and like, I honestly don't know within our time frame how to tell you guys about this extraordinary man. He's both politician and business owner. Mark, I'd love for you to just kind of introduce you to the entrepreneur audience that we have here today. Introduce yourself, tell us a little bit about your journey, both in business and in politics on your side of the world. You can tell them where you're calling in from as well. And then we'd love to hear your thoughts on kind of just, leadership principles in entrepreneurship, and how do you build something that's meaningful and relevant in this world. Over to you, sir.
Greetings. Can you hear me?
Perfectly well, thank you.
Wonderful, wonderful. Greetings to everyone, and good morning to those who are on my side of the world, and good afternoon to those who are in the area of South Africa. It is a distinct privilege and honor to be offered the opportunity to contribute to this conference, speaking specifically, I think, on leadership and entrepreneurship. As a little background to myself, I'm calling you now from Miami, Florida, but I am based between Miami, Nassau, Bahamas, and my home, which is Bermuda. And from Bermuda, I'm able to operate my company called Axum Limited, which is focused on technology, and specifically online gambling, online gaming, financial technology with an emphasis on the mobile money industry. And also we are looking to go to market soon with a gig economy app that will be able to connect persons who are looking for short-term opportunities with short-term or demand for labor of any sort. And so our group is very focused on the digital economy, especially now as we transition into a post-pandemic environment. In addition to technological focus, we also own and operate a law firm and a corporate service provider in Bermuda and in the Bahamas. And I was very interested and grateful to hear the previous speaker before the gentleman, Mr. Bullock. I forget her name, my apologies, but I got a glimpse of what she was saying, and I certainly agree and encourage the ideas that she was putting forward in terms of using structures to give entrepreneurs the flexibility to be efficient and effective in this post-pandemic environment, especially. As a background to myself personally, I am the son of one of Bermuda's longest serving farmers and fishermen. And so my roots are based on primary industry and entrepreneurship, and at the core, where if you don't put in, or what you put in is what you get out. If you don't work, you don't eat. And you must be able to have the ability and capacity to take risk. And so there's experiences as a young man coming up, which prepared me most importantly to enter into the business realm, and at the same time also to contribute at the public service realm as a political leader at some point in my time. But I do not allow politics to define me as a person. In fact, my spirit is very much on the free market side of things. So politics has its place, but it doesn't have that much of a place. And for me, in terms of the improvement of people's standard of living in Bermuda and around the world, I think that good, sound, ethical business principles and practices would be the ultimate solution over the long term. Now, in saying that as my brief introduction, I would speak to leadership, but leadership in this context. Let me make the distinction, especially now, I think is very important. Political leadership is not the same as business leadership. They couldn't be as different unless, as a business person, you are dependent on your proximity to the halls of political power. And that makes you basically a what they call a crony capitalist, if you like. Okay, but for the majority of the people in the world who actually have to take risk, then the leadership principles that are useful in politics are not the leadership principles that are useful in business. In business today, value is going to be found in leaders who recognize the value of their own teams, recognize their own limitations, and they apply themselves in practice with a high degree of self-discipline. Self-discipline is the seed of human power. And if you are going to develop a corporate culture which encourages innovation and creativity and enjoyment and happiness, then leadership has to be exemplified by those who are actually leading the entity. And exemplification of leadership comes through the most important component and characteristic of a leader, and that is having a very disciplined mind. Once you have a disciplined mind, you will have the requisite humility to be able to seek and acquire knowledge, wisdom, and understanding. It sounds simple. We all know what knowledge is, but do many of us recognize the wisdom of acquiring knowledge? The wisdom of knowledge is the experience of seeing that knowledge being manifested in your real life. But you know, there's something a little higher than that, more important than just acquiring the wisdom of the experience. And that is to understand the experiences of others and to put yourselves in the shoes of others. That is understanding. Now, as a leader, I think it's essential, because if you're going to develop a corporate culture that is innovation driven, then you have to make a decision whether or not you are going to be a micromanager or you are going to be a macro manager. In this post-pandemic world, we see the political environment becoming more and more micro by the day in every single environment, everywhere, more and more micro. Political leaders are seeking to really put their fingertips on every aspect of our lives. Today, I would say that the business leader needs to take the opposite approach, and that is to encourage freedom of expression and freedom of activity by those who work for you. Because without that top line corporate culture of innovation and creativity that can only come from a free spirit, then you're going to find yourself in the digital economy losing value and not being able to compete vis-a-vis other competitors who understand the value of giving people the freedom to be themselves. And so that is the type of approach I've taken in terms of how we shift and adjust our business practices since the global lockdown of COVID in March and April. We had to make some adjustments, and we had to become more open and let our team realize that, listen, as we go through these challenges, our dependency or reliance on you to be yourself becomes paramount. Do not depend on us to give you or do something that you can do for yourself. Now, at the same time, in giving them that freedom, they also have to be willing to give that reciprocated respect, where it doesn't require the degree of minute control on their daily activities to allow them to be innovative. So it's got to be mutually beneficial. And that requires the cultivation of a spirit and culture within your organization that, again, people feel that they are part of and they are happy to participate in, whether it's done remotely or within an office environment. So I would say that I'm just got a little one or two notes, excuse me. Going forward, as entrepreneurs, we have to decide in terms of how we go about developing our teams and this leadership idea in this post-pandemic world. We are going to have to decide what are going to be the core strategies to create that good vibe within your and high productivity within your workforce. And again, it comes with having this understanding of developing synergy and looking for persons within the group who can work as best as they can with one another as a team. And that requires, again, your example. How do you encourage people to interact with one another? How do you encourage them to be innovative? And how do you encourage them to respect their colleagues' innovation and energy and creativity? In other words, you cooperate in order to be competitive. That is the corporate culture that's required, I feel, to navigate into this 21st century post-COVID environment. The last step, I would say also, most importantly, is that there is a need for, I mentioned self-discipline. I would encourage leaders to take time for yourself. Take time to meditate. Take time to study. Take time to think. Take time to seek and project your mind, not for today, but think about what's going to happen next year and in 3 years' time. Strategically, but practical. You must stay ahead of your vessel. From a pilot's perspective, a good airplane pilot is always 100 miles ahead of his aircraft or her aircraft. Likewise, a good business leader and entrepreneur must always be ahead of where their business is. So they have to anticipate. They have to have an erudite idea or a vision of where they want to take their company and how they can navigate their company in a post-COVID environment that's going to have all sorts of external risk thrust upon you that's going to require you to have flexibility and vision to navigate. And so I think for us in Bermuda, we are facing the same challenge that you're facing in South Africa and Mauritius and in the United States. And it's going to require not a desire to be more controlling, as political leadership are starting to exemplify around the world, arrogantly so. But I think that we need, as business people, to seek to go the opposite direction and extend as much freedom within your teams and within your business, so innovation will create the value that you seek in the future.
Sure. Wow. Mark, thank you so much. I mean, I've made a ton of notes on this side, as I'm sure all of our participants definitely had. Thank you for that kind of just that reminder on, how important the team and the culture of innovation is. I think, allowing your people the freedom to innovate, to grow the business is definitely a really good point. And I loved kind of the principle of self-discipline in this time you mentioned. Like, as we see the COVID numbers still climbing worldwide, it's kind of not a, people have spoken about now that COVID is over, like, COVID is still growing, and 2021 is like starting to become, more and more looking like 2020 did, and even potentially worse. So I think, that discipline of how can you make this a long game? How can you, take care of yourself to, in terms of meditation and balance, but also find that time to be able to do that forward thinking work that you need to be doing to, where's the world going? Where's your company going? Where must you as a leader go, that you can reflect and understand the limitations within yourself or within your organization and how to really attack that. So yeah, I think so many good lessons. Thank you for all of that. And thank you for your precious time. We super appreciate it.
The honor and privilege is mine, I assure you.
Sure. No, thank you. I know it's an early morning for you and Pepper. Yeah.
But thank you so much. And I hope everyone has a peaceful and productive day.
Brilliant. Thanks for joining us, Mark. I mean, if you still have a couple of minutes, we're going into a Q&A session now. If I can invite all of the speakers who are still with us, who've been able to stay throughout the whole session. I know lots of them had to unfortunately go because of schedules. But if there's anyone who's still able to jump on, won't you jump on with us for a few minutes? We just want to hear if there are any questions from the floor. You guys can switch on your cameras and pop up if you can. And then just to the audience, then, I think either the Q&A or the chat, you can use either. If there's a specific question, if it's directly for an individual, for one of the speakers, or if it's just to the panel, you're welcome to post those up, and we'll have a look. Great. I'm just giving the guys a chance to quickly jump on. Dustin, for you and Simon, I'd love to, while we wait for everyone to type up their questions, I'd love to see if, I think we had 1 or 2 points I felt in your session that we didn't quite get to. I would love to give you the floor to say, like, look, if there was one more thing that you felt needed to be said in that session, like what would that have been?
I'm going to punt this one to Dustin first, because I felt like I hugged a lot of that.
Dustin first.
Thanks, Simon, for the hospital pass. I'll remember that. Gosh, Lo, I think building for sale, that was our topic, and let me just perhaps keep with that. I guess one comment I have to any founder that is looking to embark on this process, it takes a long time to do it. And whether we're talking about earlier stage businesses or certainly more established businesses, the message remains true. It might change a little bit, it remains true. In that, focus on what the acquirers are looking for, what the solution is to the problem that they may be facing, how they're going to view your opportunity, and kind of build your business to position within that acquirer market. The way to do this is to step out of the role of an executive or a manager or a director within your business and become a shareholder. Really become a shareholder. So take some time out to look at your business from the top down as the investment that it is, and almost buy your business back from yourself periodically. I'm always curious as to how clients or founders come into this environment and they're looking to sell their business, and every single transaction that we do has a 100-day implementation plan that follows the transaction, right? The acquirer will come in and they will discontinue a certain division, or they will sell certain non-performing assets, or they will bring on talent that was missing in the business, or get rid of some human resource that wasn't necessary in the business. And yet owners of businesses seldom do that. They seldom look at their business through the eyes of an acquirer as though they're buying their business back from themselves continually. And I would just simply encourage that. There is no better way to prepare your business for sale than to systematically purchase it back from yourself and continually make that reinvestment into your business as though you're a fresh acquirer.
Yeah, no, I love that, Dustin. Thank you very much for that. I think the more you can bring that approach to the table, I think the more value you'll derive from it. Thanks.
Yeah, I want
to sense. Yeah.
Exactly the word that you just used, low value, right? So if you do what Dustin just pointed out, you'll focus on creating value. So firstly, you'll probably have a hard chat with yourself about whether your business is solving an actual problem that someone values, or whether the product market fit could be tweaked. And secondly, you'll probably take a hard look at the kinds of partnerships that you have, either with vendors or with clients. And if you're focused on creating value rather than extracting a top-line revenue number for the sake of pumping and dumping, you will inevitably lead towards trying to create sustainable partnerships rather than extractive partnerships. And it's if you're focused on growing very aggressively, it can be a hard trade-off to make, and because there's a key difference. Sustainable partnerships almost always require more investment, have lower yields of profit, if any at all, in the short term, whereas extractive partnerships tend to fizzle out or go away or shrivel on the vine. And a good example of that is in the quick service restaurant space, with food delivery aggregators. They are finding that the short-term extractive partnerships that they built with the likes of McDonald's, KFC, etc., are starting to wither on the vine because of the fact that they were too focused on driving aggressive revenue growth instead of building sustainable partnerships. And their partners are now looking outside of them, and it's creating opportunities for other businesses. And that's the trade-off that was made, and those are the benefits, or those are the consequences that are being reaped. So act like a shareholder and try to create value.
Yeah,
Thanks.
I agree with Simon. If I could just jump in there for a second as well. I just want to say one thing. I feel quite sorry for early stage businesses in today's environment. I said it before when we in our first session, and I'm going to say it again. I think too much pressure is placed on founders in today's business environment. That could be through capital raises they've done with inefficient partnerships that came on, guys that were or investors that were looking for too early growth or profit extraction, and they didn't focus on the right things. I must drive that point home. So yeah, I'm not saying that your business shouldn't have solid founding principles or fundamentals. That, you know, that's obviously you must use OCFO for all of these things to get your systems and your reports and reporting and governance structures right. That's key. But businesses that are operating in a jurisdiction like South Africa that are fairly early stage or developing are expected to have problems. Don't try and be perfect. Don't put pressure on yourself to be perfect. The acquirers are expecting it to have obstacles and not be perfect. Trying to make yourself perfect is going to divert your attention away from the best thing you have going for you, which is your ability to adapt, to innovate, to move quickly. That is what acquirers are looking for. So focus on that. Don't try and be perfect.
Pepper, I see you nodding your head there. I think the concept that Dustin mentioned earlier was around sitting down and acting like you're buying your business from yourself again. I love that. I wonder how you would take a founder team through a process like that.
Thank you. I really like what Dustin said. It's you have products, but it really is the leadership and your ability to adjust. And businesses have to adjust all the time. I mean, really to stay to your constant value, you still have to do daily adjustments because the world changes. Each day brings new challenges. So that ability to be nimble, and that was part of my presentation, to give you certain steps. Like I sometimes forget, and all of a sudden I go, I'm stuck. And then I go over and I say, oh, do step 1, do step 2, do step 3. It's microseconds to go do that. And I go, oh yeah, here's an opportunity. But I think that ability to adjust, just a quick story. So I'm starting an academy right now, a leadership academy. We were planning to have people come in for classes, 16 to 18 people. We had 2 years of developing our programs. We had all this set up. We bought real estate, and COVID hit in March. And I'm sitting there and I'm going, well, my whole model just blew up. And so then I'm being interviewed by a group in California, a media group. And just during the questions, the person was trying to get to know me, said, well, so how was 2020 for you? Instead of complaining, I just stopped for a moment. I don't know why, but I stopped and I said, it was the best thing that ever happened to me, because I was thinking of 16 people in a classroom. And this forced me to go into thinking about, well, how might I have a wider group on Zoom? The whole world got trained on Zoom. So now I can offer classes on Zoom. So now I have group, but some of my classes are breakouts and get very personal. Then I thought about how can I have independent study? So now you have sort of mentoring independent study within Zoom. My model has changed 6 times in the last 9 months. And I think each change has made it a little bit more robust. So that's my take. And I really like having sat on. Everybody was tremendous, but it seems like my presentation just built upon what Simon and Dustin presented earlier.
For sure. Guys, we've got one question from the audience here there's a second one coming up. The first one, Jared from Startup School has asked, he said, thanks for today, very helpful. Just one question. He sees a lot of focus on fintech, but what are the other businesses out there that are really getting attention from VC in South Africa? I know we don't have specifically our venture capital friends in here, but Waze and Jock, I know you guys deal with within the fundraising space for ventures a lot. What industries are also getting attention apart from the fintech guys?
Thanks, Lo. Maybe if I can go first for that one. Obviously, EdTech is a big other one. That is, I mean, the digital platforms just really open it up in terms of, I think, similar to what Pepper mentioned. reaching wider audiences, especially with schools and universities not being able to meet physically. That problem forced them to think out of a box, and there's quite a number of ventures that really addressing that need in the market. So I think EdTech and education in that sense is really something that's growing as well. And another one is just taking some medical, in the medical industry, whether it's, I guess, to a degree data, collecting data of users and just creating a platform whereby different users can either map that out or users can get access to whether it's doctors assessing them digitally or things like that. So I think those two areas are the two areas that stand out for me in a big way.
If I can add one from my side also, there's also a lot of development funding institutions always looking for businesses that create jobs. So government banked financing institutions, if your business can create jobs and it's a sustainable, there's always funding available for businesses like that. So it's not just necessarily, it doesn't have to be a sector, it doesn't have to be fintech. If we can, I mean, if South Africa is struggling to create jobs, there's definitely financing available for companies that can create sustainable jobs.
Brilliant. Thanks for that.
Can I, Lo, do you mind if I just jump into there? And I want to follow on from what Uwe said now. I don't think it's necessarily sector specific. I certainly don't see that. We don't deal a lot with VC, but the bits that we do, if you just understand again, a venture capitalist position, they are looking to take a position as an early partner in a business's development and provide sort of strategic and capital input relative to that business in its early growth life. So it can be any sector. But a VC needs to be able to demonstrate when they are getting out, what their exit is, and are they able to meaningfully contribute to that business to get out at a higher multiple. It can be anything, as long as, even if it's an old sunset kind of business, a traditional business, they're still going around, they're still existing, the world is still turning. People are looking for talent and they're looking for disruptive methodologies, not only technologies. So if any business, any sector can demonstrate that they can adapt and can move and can keep up with the times, and they are energetic and they are, motivated, then yeah, a venture capitalist will look at them because they've got a lot of positives, but they're also focused on getting out. A VC is very focused on getting out. So yeah, I think any sector is attractive still.
Thanks, Dustin. Yeah, one more question here from the panel is just around networking. Carl asked a quite broad question around, how does one go about building good networks and partnerships in this ecosystem? You used to be able to see people in person, have a coffee, have lunch, build a relationship, go have a drink. Those kind of things don't really exist in this kind of environment, and it might not for the next, quite a lot of months, maybe maybe years. How does one go about networking within the entrepreneurial and business ecosystem? Who would like to take a stab at that? Maybe Mark and Deanne. Do you guys have any thoughts on that?
Okay, I would say I think one of the best ways to market in entrepreneurship is to come to events like this. So kudos for being here. And if you follow Also CFO, we do a lot of founders events, conferences. We'll link you up with entrepreneurs. Another thing to do would be to find networks for entrepreneurs. There's Startup Grind. There's a lot that are out there. They are still doing online events. And then when you identify people in your industry, people you want to look up to, I always pop people a message on LinkedIn. Still a great platform. I think always can vouch for that. So I think a lot of business happens on LinkedIn. Pick up the phone, speak to someone. Yeah, I think those are still areas where you can network in, whatever field you are in.
Mark, do you have anything to add to that?
Yeah, I agree with what's been stated. We had to adjust, to a new normal. And so, we have to redefining how we have relationships with one another and how we communicate. And I know that now, even out through Zoom, it's effective because I'm able to speak to at least multiple, brilliant people, at the same time. But I could tell you that personally, me and my wife, we are planning, in January, the new year, to get on the airplane and come to South Africa as soon as possible, because we still feel the value and what desire is of meeting with you, and meeting with your team. And we have some other relationships in South Africa too, that we just think is the value is enough for us to get on the airplane and travel for 24 hours. Okay. So in spite of the new environment, in spite of the new norm, if the opportunity arises still to have that face-to-face touch, flash, share a cool one or a cup of coffee, then that's something that you can, if opportunity arises, take it. Take it.
You can't replicate that, right? That kind of ability to build a relationship between two people face-to-face, it's just hard to replicate, right?
Yeah.
Hello. I don't know if I'm muted or not.
No, Richard, and then we'll give Pippa a go as well.
I think the one thing that I would say, and I think it's probably the one thing that hasn't changed, with obviously with COVID and how people are talking, but I think it's to have a genuine concern for the people that you are involved with, for the people that you work with, for the people that you're meeting, because I think so often people they're at networking events or they're at these various forums and they're just trying to market themselves, and I think that doesn't work. Maybe it works for some, but I don't think that it works, because I can tell when someone has a genuine interest in me and someone who I can see really wants to connect with me, versus somebody who just wants to try and sell me something. And I think that for me is a key.
For sure. No, for sure. You definitely you have to sidestep those at networking events sometimes, right? Pippa, you mentioned you also have a thought. Would you like to go next?
Thank you. Last week, I had an opportunity to be on a call with Horst Schulze. Horst is the gentleman who literally was chief operating officer and the co-creator of the Ritz-Carlton. He's the guy, he's 83 years old. He is the person who coined the phrase in hospitality, "my pleasure." What a great time we were sitting there, and he was challenging us. He was challenging us because it's almost like Mark's response was, here we are in this virtual world. I have to have this need for a personal touch. So it may not be as often, but so between virtual and personal, and he was challenging us in between. And I was saying, what's in between virtual and personal? I don't understand what's in between. And then he kept pushing and pushing. It has this German accent. He's going, you need to go, what's in between? And he came up with some words. And one of the words is think generous. Now is a time where maybe like Delta Airlines is still staying with the middle seat empty. It's costing them a lot of money. They're the only, but that cost, that investment is changing their brand for post-COVID. They're building a loyal audience. There's a difference between a follower and a like and a loyal audience. This may be an opportunity to have a loyal audience. So one of the things I'm learning to do is start to delight people that I meet. So Richard, when I meet somebody in a network, it's not about trying to get something from them. I'm trying to think, how might I be generous? So I might send a book to them and say, really enjoyed your comment, thought you might enjoy this book. Cost me a little bit from Amazon, cost me a little something. But those little gifts of generosity. Here's another thing, a personal handwritten snail mail, writing a note and sending that to somebody in today's world is unexpected. It's not virtual, it's not in person, but there's a whole scale in between here. And I hope that our participants might start to say, you know what, how might I think about that scale? What else is in there?
Thanks for that, Pippa. Because I think we've crushed through the questions, and I think we've also hit the end of our time frame. And it sounds like they've started building next door here with us now. So I think on that interesting note from Pippa, I think we're going to wrap things up. I think we've heard from a lot of different, very interesting founders and investors and leaders who are all experts in their field today. It's been such a privilege to have everyone here. For all the speakers still with me, super big thank you to all of you guys for your time and for sharing your years and decades worth of experience. A shout out just to Receipt Bank, who are our partners in this endeavor. thank you very much for coming on board as our headline sponsor, and just kind of like backing all the entrepreneurs and professionals in a timeline such as this. We hope to have all of you guys back for Founders Conference next year, same time in Global Entrepreneurship Week, where hopefully we can all see each other in person with kind of a COVID vaccine already in. But yeah, wishing you all the best with your ventures and best of luck for everything. And we'll keep following your journeys.
Thank you, Lo.
Thank you, everyone.